Thursday, January 26th here in New York City. This is Yahoo Finance Live. I'm Brian Sozzi with Julie Hyman and Brad Smith. Here are the top 3 things you need to know right now. Tesla delivers sort of. The company reported record revenue and beat earnings estimates, setting shares into rally mode this morning. But Elon Musk warns that there are uncertainties ahead. We'll talk to one analyst who slashed his price target on the company by 50% a week ago in just a few moments.
Plus, layoffs mount in tech. IBM and SAP, just the 2 latest companies to add to the wave of tech layoffs as businesses cut back after rapid growth during the pandemic.
And later in the show, from blue jeans to cloud computing, we're going to speak to Levi's CFO Harmeet Singh and ServiceNow CEO Bill McDermott. Those are 2 interviews you do not want to miss. But let's begin today with a check on the markets. Futures this morning are pointing higher across the board. The Dow, the S&P 500, and the NASDAQ are higher as the NASDAQ is up by a little more than 1%. The Dow Jones Industrial Average up by about 0.25%, and the S&P 500 up by 0.6%. But we have to begin today on the latest economic data, guys. The U.S. GDP came in at 2.9% in the fourth quarter. And taking a look at a much more longer ranging kind of chart here of some of the ebbs and flows that have taken place in GDP. This comes as we do know that economists who have been looking for or just monitoring the possibility of a recession this year, closing out 2022 and what we did see at the tail end of last year for the final 2 quarters, that could look vastly different than what we see here in the first 2 quarters of this year as well, given what they're signaling too.
Yeah, but I think what's interesting about the economic data that we're getting today, and we're getting both GDP and jobless claims, is that it points to not as protracted, not as sharp, not yet a slowdown. Now, to your point, will we have a slowdown to come? Yes, probably, and the preponderance of economists are still expecting a recession later this year. Nonetheless, a lot of the numbers that we've been getting in and a lot of the commentary that we've been getting sort of on an anecdotal basis is not as bad. Yes, you had personal consumption in this report come in with an increase of only 2.1%. That's worse than estimated. But we keep hearing a lot of different CEOs, and it's being seen in some of these reports on the consumer side. Things actually seem to be holding up okay.
Yeah, I'm surprised to see the market reaction to this report. I thought the market would want to see something a little bit weaker instead of the stronger report, which would suggest that maybe the Fed has to keep going a little bit further on the interest rate cuts. But maybe the market is just taking its clue on better profit margins from corporate America because all of these layoff announcements, which have now officially spread beyond big tech. One
of the matter that the markets are factoring in this morning, jobless claims, they came in at 186,000. This is the lowest level since April of 2022. And this used to be the figure that we were tracking on a week in, week out basis because it was more real time than the monthly readings that we were getting in terms of the employment situation. And really continued to give us a little bit of a mindset of how corporations or large and small enterprises were really looking across the employment situation and figuring out how they could hold on to workers at a time early in the pandemic where we saw such swaths of layoffs, furloughs. And so now for us to be in a different situation, even though there still are layoffs being reported by some large tech companies, it still comes with this caveat that you do have at least the jobless claims ticking lower here as well.
So here's a question I have, and I should know this. When you get laid off, if you are collecting severance, can you file for unemployment insurance while you're still getting severance? Or do you have to wait until your severance runs out?
I believe, based on asking people who have been laid off earlier this year or mid last year, that you have to wait.
So then that means that there's going to be a delayed effect from all of these layoffs that we're hearing about now because those folks are getting severance. Right. So at some point, we're going to see the effects of that.
And that comes at a time, I just want to toss this red flag onto the field too. The personal savings rate, only 2.9%. You really get the sense that consumers, of course, were hit over the head with inflation last year, and you have to wonder, well, what is their capacity to spend this year? That's a really low savings rate, given the rise in personal income.
Yeah, it seems like there's a lot of optimism around their capacity to spend, though. So we'll see how that plays out, given the hard data. Well, Elon Musk tried to end investor uncertainty about vehicle demand on the earnings call last night, suggesting that the EV maker's recent price cuts have resulted in a surge in orders. Musk said on the call that January has had the strongest orders year to date in Tesla's history. And this, by the way, is a relief for investors because those orders had been trending downward, right, for a couple of quarters. So to see this bump there, according to Musk, I mean, it's a good thing he made that comment because otherwise This was not a fantastic report. Earnings did beat estimates, yes, but automotive gross margins were below estimates. Free cash flow was way below estimates. And so it feels like the gain that we are seeing in the stock is mostly due to tone on the call rather than the hard data.
Yeah,
You're just waiting. You're just
no,
waiting.
I think you're right, Julie. There was a lot to unpack here, and I have a story on this now on the Yahoo Finance homepage, digging into that earnings call. And of course, you and I, Brad, talked about it after the call last night. And in addition, Julie, you had a sleepy Elon Musk. He had a lot going on. He just did not sound like the normal Elon Musk, whatever you would like to hear from him. But I think the stock is also trading off of the Investor Day that is coming up in March. A lot of, I think, new product announcements were teased by Musk on that conference call, giving hope that maybe by mid-year the back half of this year, you get a re-acceleration in growth out of Tesla. But of course, Musk did warn a good deal about recession. He
did, and when he talked about a recession, and this is what the stock was initially reactive on in after hours, and it continues to move higher here, at least pre-market. Right now, it looks like it's up by about 10% at one point, but it's really how he framed it and how it would impact Tesla. He said if the recession is a serious one, and I think it probably will be, but that will be leading to meaningful ones. And actually, I believe we have the SOT, so let's just take a listen here. Sorry.
If the recession is a serious one, and I think it probably will be, but I hope it isn't, that would lead to meaningful decreases in almost all of our input costs. So I would expect to see deflation in our input costs most likely, which would then lead to better margins. But I'm just guessing here. So that would be my guess.
Okay, so you heard his words. You didn't need to hear me kind of recite my chicken scratch that I'd written down in the middle of the call. I know, it really is. You can't really read it very much. But at the end of the day, it really comes down to some of those raw materials costs and saying that this would actually be a deflationary type of environment that they would be looking at in some of those materials costs. And one most notable material is lithium. It's raw materials and inflation led by lithium prices that they talked about in previous calls, that they talked about at length in this call. And that's going to continue to impact their cost of producing cars over the course of 2023 as well.
Yeah, if you're buying Tesla shares here at the open or looking to, you also, I think, generally have to have a belief that these price cuts that they just enacted will not take that gross margin, to your point, Julie, below 20%. And then they will also lead to a demand reacceleration in the first quarter and then an acceleration off of that into the second quarter. But again, a lot of unknowns there, just given where we are in this economy.
I mean, the company said on the conference call, they're not going to go below 20% on the gross margin. So do you believe them? Do you believe that the costs are going to abate? The CFO cited not just raw materials and inflation as to blame for the increase of cost of goods sold. They're also working through the early ramp of inefficiencies in Austin and Berlin factories. So in theory, that should abate over time as well. They also said the vehicle mix over the last year has moved more heavily to the Model Y, which costs them a little bit more to make than the Model 3. So will that remain in place, or will that the real question is, will each of those things correct enough to boost the margin once again? I do believe someone asked them on the call, will the profit per each car return to the level where we saw it, say, 2 years ago? And it sounds like that's not going to happen this year, at least. And again, there's this tone of uncertainty about when they're going to be able to get back to those levels.
Yeah, absolutely. They've noted an average selling price right now of $47,000. So that margin, that 20% margin basis on a $47,000 average selling price is what we're going to get into with our next guest as well. What should make investors of Tesla stock after the earnings report? Let's bring in Jefferies Global Autos analyst Philippe Houchois, who is joining us this morning. Longtime bull on Tesla, just recently slashed your price target on the stock by 50%. Why?
Yeah. Well, if you look at what happened in the past few months, combination of the market rates going up, the absolute growth story around Tesla being questioned, and also what happens to the inflation or gross margin. So I think we've put that into context of lesser growth, uncertainty about the margin progression, much more volatility, and a different environment that led us to revise the upside on that stock.
So you still, though, again, are a buy on the stock. Would you be a buy, particularly in the wake of this report?
Well, what yesterday what was interesting is it was a miss, definitely, but I think the consensus right now is a big, fast-moving target. So it's hard to I think it was within the margin of error. I think there was, as you discussed, I think earlier, there was a number of indicators about, as they ramp up other plants, battery cost improvement, that can, and the IRA impact as well, could easily reverse maybe 5 percentage points of margin. So I think this is not going to happen immediately. Over the next 4 to 6 quarters, I think that's the clawback in margin, and that was quite interesting. I think what's important to us in Tesla for us is two things. The issue entering 23 in autos was affordability everywhere. And Tesla is a brand that the mission is to make that transition possible, and therefore affordability is a core value. They've addressed that. For a while, they enjoyed, like everybody else, excess earnings in COVID, and they decided to take a look at a cost curve and then decide to go for affordability. That's a very important event for us in the industry. And then, of course, Tesla continues to challenge just about everything the industry does. And we think that if they execute and what they intend to do and they deliver it and are able to put in place what they want to do, I think the outcome is a much more efficient auto industry. But that's going to take some time to validate that. But those are, for us, the key beliefs that we have around Tesla.
Felipe, how concerned are you that Elon Musk is just doing too much? Now, we were on the earnings call last night. He sounded a little sleepy. All right, he's testifying in court. He said he spent Tuesday late night talking to the Tesla AI team. And then on Twitter a couple hours ago, he said after he did all that, he spent more time at Twitter's headquarters. I mean, Elon Musk is Tesla. How concerned are you that he's being stretched thin and Tesla's going to be impacted?
Yeah, no, it is a concern. It has been for a long time. And I think we've published research many times in the past where we say the thing is, one, the enemy is inside of Tesla. Musk is an incredible driving force, but he's also the one that brings unnecessary risk in a way to the situation. At the same time, what we have to keep in mind is what we say as well is Tesla is bigger than Musk, so he has been the impetus. The question with Elon Musk as an individual is he does a lot of things, maybe too many things, but it's not like he's going to listen to, if you tell him what to do, he's not going to do it. He has to self-correct. So he is the person who is going to decide, can I do SpaceX, Tesla, Twitter? Do I have to
can he, though,
delegate more?
Do you think he can?
Exactly. No. Yeah. Well, that again is you're not going to tell him, and I'm not going to tell him because he won't listen. It's up to him. He's going to have to make that decision. And what we need to be comfortable with as investors, let's say Tom Zhu has been rumored as being a number 2 coming in. Great news that he's got the values of Tesla, so that's an internal point is very important. But will he be given a free rein to run Tesla if that's what is decided? And that's the part. It's going to take time for us to get comfortable with that. Again, the self-correcting mechanism at Elon Musk is Elon Musk and nobody else.
Well, Philippe, at the same time, though, is Musk too dismissive of how he's perceived? Forget about is he working and doing too many things? He's like, I have 127 million followers on Twitter, so I'm doing just fine. Like all of those people who follow him like him and are potential car buyers. Like, do you think he has a blind spot here on this front?
Probably. I mean, that part of the conference call was not the best part of it, and so yes, there's a risk that he goes in a direction, believes in something, and then consumers are somewhat turned off or disappointed. I think that's definitely a risk, and I wish we didn't have to deal with that, but it's been part of the package. It's a package, and then Musk can redefine the package. We can't.
Okay, but I think at the core of this too, even if you're talking about a guy that has 127 million Twitter followers, there's still a Musk that has off-put so many of the potential buyers and even some of the retail investors who had chimed in on Say and submitted that question. They're recognizing what kind of hit that could mean to the brand in the future.
Mm-hmm. Yeah, no, it is a risk to the brand. I think the brand is interesting. The brand is very, we said before, it's a messianic brand in a way. It's about to make the world a better place in many different ways and all this. And it's a very difficult. It's such a vague in a way or unfocused brand. It's very, very difficult to manage. But again, going back to what is Tesla about when it comes to cars? It's to make the transition happen. The faster, the better to some extent. And to do that, you have to have affordable product. And the product is still very attractive. And all of a sudden, it becomes much more affordable. And so I think as consumers, yes, you can have reservations about all kinds of things, but you'll be looking as a consumer, is this a product that fits my needs? Is it affordable? And right now, we'll see how the rest of the industry responds to what Tesla has been doing. But right now, it's a very, very good value proposition.
Philippe Houchois, Jefferies Managing Director of Global Autos Research. Good to see you this morning. Appreciate the insight.
Thank you.
All right, the layoffs that are rippling through the tech industry aren't showing any signs of easing. IBM is the latest tech giant to do so. The company announced it will cut about 3,900 jobs, mainly in its IT services segment. We're seeing shares down about 2% here in the pre-market. Surprised to see these layoffs by IBM. It was a good quarter for the company, showed almost 200 basis points of year-over-year operating margin improvement. So good from that standpoint. The outlook was reasonably okay. But again, another big cap tech company using the cover of an Amazon and a Microsoft to lay off workers and maybe improve their bottom line.
Yeah, I mean, within this, the hybrid cloud revenue, that continued to look strong most recent quarter. That was $22.4 billion worth of the company's business. That was up 11%. And then additionally, you look at how they're continuing to generate free cash flow. That came in at about $9.3 billion here. But within the layoffs and what they're looking at in this environment, said Arvind Krishna, the IBM chairman and CEO, said within this earnings release that clients in all geographies, yeah, they're embracing the hybrid cloud, but this remains a force in today's business environment. However, looking ahead to 2023, full year revenue, consistent growth, mid-single digit model. What's not talked about within that is what kind of cuts or at least normalization needs to take place, not just at IBM, but we're seeing that take place on the headcount side at many of the companies in tech right now.
Yes, most definitely. This is not an across-the-board cutting in every area of the company. And, while not diminishing this 3,900 folks are going to lose their jobs, this is, I won't say it's a rounding error at IBM, but the company has 260,000 people who work there. So 3,900 is not a huge number. And at the same time, the company is still going to be hiring. It said that explicitly in higher growth areas. So as it tries to concentrate on that hybrid cloud, presumably that's the area in which they're going to be hiring, maybe cutting back in some of those other areas. That said, also, software and the infrastructure units kind of saved IBM this quarter because those two units grew where analysts were expecting a decline. So the mix, I think, is really important, and we can't lose sight of that. There is, by the way, another tech giant that cut jobs, and that was SAP. 3,000 jobs, it says, it expects to cut this year, and it's also exploring a sale of its remaining stake in Qualtrics. Qualtrics shares were going up on that news.
Yeah, I just put this tweet out there. Just one quick note on SAP. I do wonder if SAP, we have activists swirling, if this could be another potential activist target. Since CEO Christian Klein got into this business or was appointed as CEO October 2019, stock is down. It's down significantly, I believe 26%. You have the S&P up 500, up close to 37% here. At what point does this company or does an activist crunch numbers in SAP saying there's a lot of bloat, likely a lot of bloat in a company like this after a lot of acquisitions in recent years? And should they be cutting faster and cutting further and spinning off some of these divisions a lot quicker than what appears to be happening?
It's look, as a former employee of the company, it's a massive business. It is not just global in nature, but the number of different business units that they have that make up everything under a cloud solutions project, everything under and what was formerly classified specifically as a CRM division, or all of the different ways that they have basically broken out the business and kind of, in some instances, overcomplicated and over-siloed to the point where it probably could be simplified, and any activist investor would probably take a look at under the hood and echo those same comments that you just made as well.
Good perspective there. All right, well, on a more positive front here in terms of jobs, Chipotle announced it's looking to hire 15,000 new workers across the U.S. from March through May, the restaurant chain's busiest time of year. Chipotle said staffing is still above pre-pandemic levels with a total headcount of over 100,000 workers. This hiring spree comes as the chain expands in Canada and throughout the U.S. And Brad, when I saw this news, I thought back to when we talked to Brian Niccol, the CEO of Chipotle, at our All Market Summit a couple months ago. They're opening 200 plus restaurants a year. So I am not surprised that he needs these workers just to staff new restaurants. And if you're opening these new restaurants, you need more workers in your supply chain to support those restaurants. Chipotle remains one of the more aggressive chains in opening up new locations throughout this country.
And they've been brilliant about the technology strategy there. And I think that this speaks to where they're looking to not just hire to bolster the ability to open more locations should they choose different geographies to move into, but also how they enhance the customer experience within that too. You go into many Chipotles and you know exactly where that line is at, because that line sometimes is going out the door, sometimes it's overcrowded. And I think being able to decrease the amount of time to actually fulfill, similar to one of the metrics that Starbucks tracks, just time to make a cup of coffee, time to make a bowl or a taco or a quesadilla or a burrito, whatever people are going in there for. If you can decrease that amount of time, you can make sure that you're moving through more orders, enhance the customer experience there as well, and just create more employment opportunities for people too.
And again, it is a good reminder here. Yes, you're not making the same as you are, making burritos at a Chipotle as you are coding at one of these tech giants. But nonetheless, the economy is not collapsing if a Chipotle is hiring 15,000 people.
I appreciate that optimism. You're a Chipotle fan, right? You got a ball from there.
Of course.
Right? Yeah, dig it. All right.
By the way, I wanted to correct something that I mentioned earlier too, because you asked about if it's better to file for severance or if you can file for unemployment rather if you're still receiving severance. And the answer is it really kind of varies by state too.
Okay.
And so at the state level, it might be more advantageous for people to ask for that payment up front as a lump sum and then file for unemployment. There's various amount of ways to go about that, but just wanted to provide that clarity as well.
Clarification.
Absolutely. Also, be sure to tune in 11 a.m. Eastern Time tomorrow. We're going to spend the full hour diving into the layoffs that are rippling through the tech industry and our latest episode of What Just Happened, a show where we break down the top trending story of the week. You do not want to miss it. Coming up on the other side, Southwest was under a microscope this quarter. We're going to break down those earnings next. Southwest Airlines, ticker symbol LUV, reported a wider than expected loss for the fourth quarter, thanks in part to the massive holiday fiasco, resulting in nearly 17,000 flight cancellations. Joining us now to take a deeper dive into Southwest, we've got Yahoo Finance's Pras Subramanian. Pras, what jumps out to you from the report?
Yeah, Brad, we're seeing the financial damage really done here from that holiday fiasco. Southwest reporting a loss for the quarter, like you mentioned, taking an $800 million pre-tax hit from that fiasco. Like you said, 16,700 flights canceled during that 10-day period. And now the DOT is investigating Southwest over where they deceived customers over the amount of flights they could handle during that time. So, not looking good there. But revenue point of view, not all bad, though. Reported a record revenue for the quarter, up nearly 8% compared to 2019 levels. So that's pretty good. But, again, the big question is, can they actually recover reputationally from what happened last quarter?
All right, Yahoo Finance's Pras Supermania. And Pras, thanks so much for breaking that down. And yeah, it was a 725 million to 825 million range that they had given us going into this report as well. However, given what they pointed out, and I think at the end of the day, where they're going to continue to make some of those investments in capacity, that's what investors are really going to be leaning on in terms of the president and CEO, Bob Jordan. He said, in this quarter, despite the negative financial impacts due to the Omicron variant, fourth quarter 22, due to operational disruptions, we generated full year 2022 net income. And that's significant because a few of the airlines were trying to figure out how they would get back to full year profitability over the course of 2022. And this certainly kind of put that in jeopardy as well, given the final quarter and given the travel disruptions that they had to account for.
Brad, you guys know me. I'm a longtime caller out of just tone-deaf executives. And, I just think it's ridiculous. At the bottom of this earnings release for this company, they are highlighting 10 to 15 awards they've gotten from various media. Who cares? Who cares about that garbage? Investors are concerned, how are you going to bounce back from having 17,000 flights canceled in December? And I'll hop on the earnings call later, but I didn't get the sense that they're really moving with the sense of urgency that they should be. And I go down to their CapEx. This year, they're guiding for CapEx $4 billion to $4.5 billion. Last year, Brad, $3.9 billion they're spent. For a company that is likely going to have to overhaul its technology, I would have liked to see something close to $5 billion. I think that would have sent a very powerful signal that the board, executives gets it. Bob Jordan, of course, the CEO of the company, they get it, and they're looking to never have this situation happen again.
But the way that they're allocating spending right now, or the way that they've been moving, doesn't signify that they're going to do it quickly. And there's kind of two frames of mind around that. They said within this release as well that the board of directors established an operations review committee, unclear about when they will have some type of result or solution that comes out of that operations review committee, and what type of dollar figure that's going to be, because that's what investors are going to want to hear about. That's what's going to have some type of reaction in Wall Street and how the stock is evaluated, because quite frankly, given some of the conversations that we've had with analysts around the airline industry, it doesn't matter what the dollar figure is. This has just continued to be a looming cloud over Southwest Airlines, and it could have, at worst case scenario, more of a detractor type of event to their net promoter score if customers decide not to fly with or not to purchase tickets, knowing that their travel plans might be disrupted.
Meanwhile, the other airlines are doing just fine. If you look at the board today, American reported, JetBlue reported, Alaska reported. We showed how they're trading in the pre-market before, and all of them seem to beat estimates. So, maybe, Alaska actually is trading a little bit down. But, Southwest, while the negative attention is there, it seems like the others are sort of quietly just operating. Yeah,
it was interesting, the tone. We, of course, been talking about recession, layoffs, but you had JetBlue come out here and saying they're seeing solid, quote, solid demand. American Airlines, which really shocked the heck out of me, saying they are seeing a strong demand environment. And both of those companies coming out with full year guidance ranges, at least in the case of JetBlue, almost 30 cents above current consensus estimates. American Airlines, their outlook well above consensus estimates. Nowhere in those outlooks, Brad, did I see two companies prepare for a major economic downturn.
Yeah, full year net income of $127 million for American Airlines Group, and saying that they're committed to running a reliable operation, returning to profitability here. And again, that just kind of takes us back or reverts us to my previous point about how all of these airlines who are still in the process of restoring capacity to pre-pandemic levels are trying to do so and restore capacity at the same time that they're trying to retain that profitability that has been achieved either on a quarter base, on a consecutive basis for some airlines, or now finally in 2022 on an annualized base as well.
Yeah. I don't have anything else to add.
No, it's outside of this, I'm getting a lot of just different demand signals. We had the airlines come out here positive. Tesla, you had Elon Musk talking about a severe recession. That stock is ripping higher, top ticker on our site. Just a lot of confusing signals. Then, to kick off this week, you have Microsoft saying it's seeing decelerations in so many parts of his business, notably the cloud, and that stock got hit.
Well, for Microsoft, it's, kind of a compounding or an intersection of a few things. It's cloud spending, and then it's additionally the spending that they're doing to make sure that they're investing in that next wave or next leg of growth. GPT, whatever that could be in the near term and long term. It's just a question of how long of an arc investors have the propensity to stomach some of that risk in the spending that they may be dealing too.
There's the opening bell on this Thursday morning. Latin Finance, as you can see, is ringing the bell as investors consider all of these disparate earnings here this morning.
My guy, John Tuttle. We saw him in Davos. Good to see him up there.
Yes,
Big John fan.
From NYSE. They're up on the podium this morning. And, you know, it's tough on a day like this, I think, for investors to sort of come away with just a single narrative, right? You've got Tesla, which on its own sort of sets its own narrative. But beyond that, it's tough to see that there's a specific trend among the earnings that we're getting today.
Yeah, it's a bizarre time. Texas Instruments this week, weak outlook. Microsoft, weak outlook. ServiceNow operating, or their earnings call last night sounded like GDP was off the charts, or could be off the charts this year. Brad, a lot of puts and takes here for investors to wade through.
Yeah, absolutely. Well, out of the gate here this morning, we are seeing green on the screen. Dow Jones Industrial Average, let me put that on chart view for you, and we'll populate this entire week for you. How about that? Dow Jones Industrial Average, that's up by about 0.3% here on this Thursday, or Friday Junior, as our friend downstairs likes to call it. Additionally, over the past 4 days, up by about 1.4%. NASDAQ Composite, that's higher by about 1.4% out of the gate here on the day. Past 4 days, nearly 3% in gains there for the tech-heavy average. S&P 500, you're seeing that over the past 4 days, up by about 1.9%, and 0.8% added here out of the gate. Let's take a look at some of the sector activity as well that we're tracking here. And for the 11 S&P 500 sectors, you got 3 of them in negative territory as of right now. XLB, yep, materials, that is bringing up the caboose. It's down by about 0.4%. XLY, you got some takes on consumer discretionary here that are looming large in the market. They're up by about 2.25% for XLY as of right now. Well, coming up on the other side of this short break, Sherwin-Williams is taking a hit at the housing market. Well, the housing market is slowing. We're going to discuss that next.
Let's get to some more opening bell movers for you right now. Sherwin-Williams Company, the paint company, reported mixed results, missing on the top line. The paint manufacturer also issued weaker than expected guidance for the full year. And not just weaker than expected guidance, but like really weaker than expected guidance. I mean, the upper end of its forecast for the full year for earnings is $8.65. The estimate was for $10.18. And this is a company that also struggled throughout 2022, as we saw falling demand for paint related to the housing market. So it's interesting here that this is still going on. This is even after the company says that raw material costs are falling, that they expect those costs to decrease by a low to mid single digit percentage. So
the stock really getting painted with red today, Julie. Really?
I think getting shellacked is
getting
what you're looking
shellacked.
for.
Well, look, here's another company, I think, and we've seen this with a lot of consumer products earnings recently. I have consumers pushing back on price increases. And if you go division by division at Sherwin-Williams, they have pushed through seriously higher price increases on consumers. And it looks like it's starting to impact the sales run rate or the volumes of this business. And the margins were up in the most recent quarter. That's a good thing. But if consumers are pushing back on those higher prices, maybe this is a completely different margin story and a negative margin story at some point this year.
Yeah, I'll be brief with this because they actually pointed out many of the catalysts that are impacting their business as of right now, saying that the U.S. housing environment and the equation will be under significant pressure this year. They also said that slowing existing home sales continued, high inflation also going to be some of the headwinds there. And then on the industrial side, already seeing slowdowns in Europe, same beginning to appear in the U.S. across several sectors there. Plus, in China, they also noted that COVID remains a factor. Trajectory of the economic recovery there, difficult to map. And so you align all of those things and it still creates or paints a very murky picture.
It does. All right, Comcast top earnings expectations on the top and bottom lines. It's coming despite losing thousands of broadband customers due to Hurricane Ian, as well as a rough quarter from Peacock, as that resulted in a loss of nearly $1 billion. Stock not doing much here. Worth calling out, adjusted operating profits down almost 5% in the most recent quarter against a slight revenue increase. Never like to see that.
Peacock may be losing money, but it's still adding subscribers. It added 5 million new subscribers. So last year, at the end of the year, they had over 20 million subscribers. So it's seen a decent amount of growth from that perspective. And as we know, when a streaming service ramps up, that's what they focus on. They don't care about making money. We'll see if they do at some point when the page turns on that. At the same time, you mentioned cable subscribers are quitting. It was more than 2 million who quit cable from Comcast last year. So the writing's sort of on the wall with that, but still, it's not great to see that kind of a number.
Yeah, I'm doing some quick charting as well on our Yahoo Finance interactive, well, not our interactive, but on our Yahoo Finance platform, which all of our viewers have access to. And one of the charting mechanisms, you'll actually be able to see that over the long term, if you pull up that year chart, 52 weeks, they've actually broken through one of the top side resistance levels, just barely. It'll be interesting to see if shares hold above that in the near term as well.
And all Jared Blickery on us today.
Mr. Smith.
Wow, that's impressive,
channel
man.
Jared
I like
sometimes.
I dig that.
We're also watching shares of McCormick, ticker symbol MKC here, reporting an earnings miss on the top and bottom line. Sales declined 2% for the fourth quarter. The spice maker also issuing some weaker than expected guidance for the year. There you're taking a look at some of the actuals versus the estimates, and it was a miss on both efforts there.
This is not the first challenging quarter for McCormick. This might be the third or fourth one in a row. And I can't blame myself for it because I'm an aggressive buyer of Frank's Red Hot sauce. I really do put that shit on or SHT on everything, as the commercials say, as the marketing says. But look, here's another company still dealing with a significant amount of inflation, trying to push through price increases, but consumers pushing back. And then also a lot of consumers still going out to eat in restaurants. And of course, if you're going out to eat at an Olive Garden or et cetera, you're not at home cooking food. And of course, being at home during the pandemic really helped the likes of McCormick.
Yeah, the gross profit margins here is not looking great either. 36.8%. So that is down several basis points versus a year earlier and below estimates. The company also blaming part of this on COVID-related disruptions in China, so that was a problem for them too. I don't know. I was just thinking about this. I put yellow bird sriracha on a lot of stuff, but or chili crisp, the
yes.
Lagamama, whatever,
yes.
however. So I have to look at who makes those. I'm not a Frank's Red Hot kind of girl.
I don't really do the Frank's Red Hot. I'm sorry.
Okay, all right, fair enough, guys.
We actually get our seasoning and some sauces shipped in from Texas.
Mm-hmm.
Yeah.
Oh, well, pardon me. This is a custom spice guy over here.
And also some technical analysis.
I almost had you buy some spices for me from Pike Place.
That's true.
That's Seattle.
All right, coming up, Yahoo Finance Jared Blickery. Speaking of technical wizard, he will be right back and talk about some market movers. We'll be right back. Welcome back to Yahoo Finance. Let's get over to the Wi-Fi Interactive, and that is where we find our very own Jared Blickery. Jared.
Hey guys, well, everything's back to normal, at least for 2023. We got the NASDAQ outperforming, that's up 1.3%, just about outperforming the Dow by about 90 basis points. S&P 500 somewhere in the middle, around 0.7%. Let's take a longer term look at the market here. I'm writing about this in the morning brief. Here's the S&P 500 over the last 3 months. We are now knocking on the door of those highs from a couple months ago, late 2022. You take a look at the NASDAQ, very similar situation. Dow, much higher in its own regime relative to its all-time highs, but not quite there knocking on those 2022 highs just yet. But I've been looking at the Philly Semiconductor Index, and this is on a long-term basis. Let me just put a 2-year chart here. We have broken out of a couple of different trend lines here. You can draw these a couple different ways. Suffice to say, markets are trying to break to the upside, and in as much as tech is leading, we should expect that to continue. But the Dow relative to the NASDAQ, that ratio has gotten really stretched to the downside. I've been talking about 2022 as the year that the Dow really outperformed massively the NASDAQ. Well, that's kind of mean reverted a bit. So if we do go higher from here, I'm expecting it to be very quick, but also very fast and furious. So we'll have to see if any of that plays out. The alternate scenario, by the way, is we simply roll over at current levels. And these breakouts that I've been looking at probably just constituting very short-term false breaks to the upside. So those are the two scenarios from here. Consumer discretionary, the best sector of the day and the week, energy, tech, communication services, all of those outperforming. So we have the mega cap sectors plus energy doing very well. Let's take a look at the downside. Utility, staples, materials, healthcare. For the most part, only defensive and one material sector actually was in the red. Let me just show you the 4-day price action here, just to reiterate that the mega caps really in favor this year, plus financials, all of those sectors outperforming. By the way, one quick thing here, just got to show you this. The number one stock of the week is Tesla, and you take a look at the number 2, Rivian, Lucid, EV, really flying this week.
All right, the electrified EV trade. Jared Blickery, thanks so much. Appreciate it. All right, social media is still on egg price watch, and rightfully so. The cost of a dozen eggs in the U.S. has moved from $1.79 to $4.25 over the last year. That marks the largest 12-month percentage increase on record at 138%. Wow, that is a big gain for eggs. Coming up, what our next guest is recommending amid the mixed signals from earnings season. We'll discuss next.
GDP rose more than expected in the fourth quarter. Our next guest, though, says mixed signals from the latest earnings reports and economic data has left her in a neutral holding pattern. Riverfront Investment Group senior market strategist Rebecca Felton joined us now. Rebecca, we were talking about this earlier, that it is confusing right now. You have the macro data, but even amongst the companies that are reporting, some of them cutting jobs and talking about a weak economic environment. And then, as Saz pointed out, companies like ServiceNow seeming to indicate that demand is remaining robust. Like, how do you get sort of objective clarity in this environment?
Well, good morning, Julie, and thank you all so much for having me. It is a difficult period to navigate through because, to your point, the earnings season hasn't been terrific, but it also hasn't been as bad as was feared. And maybe we're going to see the end here of some of these downside earnings estimate revisions. But you do see that GDP number this morning. The job market the jobs numbers are still very strong. And even though the consumer has cooled somewhat, we are still seeing spending growth there. So there are a lot of mixed signals, but what we want to do is get through earnings season and make sure that the guidance isn't much more negative than what we have already seen before we start making decisions about where to put more money to work.
What's the low end of that guidance that you would be willing to accept, or perhaps in the range of what you're anticipating?
Well, I think as much as anything, it won't be just about earnings. It's going to be about profit margins. You know, we've already seen profit margins come down against a tough comp in Q4 of 2021. Per the last FactSet report, we saw profit margins were around 11.4%. Again, down about a point from last year, but still hanging in there with that 5-year average. So that's going to be a really important component as much as the absolute earnings numbers.
Rebecca, how concerned are you about the personal savings rate in this country? 2.9% seems very, very low. Do you think that will start to impact consumer spending at some point?
It would almost have to. And of course, that is of concern. The other thing that is of concern is the fact that credit card debt, while still manageable, is starting to tick up at the same time these interest rates are going higher. So we know savings rates are lower. Folks are having to stretch those dollars further, particularly as the essentials continue to move higher. Food prices are still very high, even though energy prices have come down. So the consumer is something that we're watching very closely. And as you know, given the component that is of GDP, it's very important throughout the rest of the year.
So watching the consumer, but are you pulling back from the consumer right now, Rebecca? Is this something that you're enacting in your investment strategy as of yet? Are you lightening up on consumer holdings, or did you already?
We had already lightened up just a little bit. The areas that we're still leaning into, obviously a little more cyclical. We're still slightly overweight energy. We are still neutral to slightly overweight in our longer horizon portfolios in those big mega cap techs. We're leaning into banks. We've neutralized our international. We're still not willing to go overweight there because we're still in a show me state as it relates to earnings. And of course, we've added back to fixed income. You know, you are getting paid to be in fixed income now. It's not just about protection to the downside. So that's also additive to strategies at this point.
And do you feel like that's your highest conviction call right now, is getting into fixed income? Or is there something else that you think is maybe a little bit overlooked that people aren't paying enough attention to?
Well, it's hard to find really overlooked because you've seen such a resurgence in some of those value-oriented sectors. So we have been adding back there. But again, we had come from a significant underweight in fixed income, if you think about where we were 6 months or so ago, and we are back more to neutral. So that is an area that we will probably be looking towards in terms of attractiveness in the coming months.
Rebecca, good to see you. Thanks for joining us. Riverfront Investment Group senior market strategist Rebecca Felton. Thanks. Coming up, Saz is going to break down some key profit points for Kimberly-Clark, and that tease doesn't really do justice what we're about to discuss. Just trust me, you want to stick around. Kimberly-Clark posted disappointing results in its latest earnings. The company, though, did reveal a few new products, and the CEO promised one category in particular would be, quote, mind-blowing. This category caught the attention of Brian Sozzi. That's where you find his take today. Now, the company reported yesterday, but you went through the call and pinpointed some key phrases.
Yeah, I didn't want to flush this quarter down from Kimberly-Clark. I wanted to dig in here and see what would flow to investors. And what he ultimately, Mike Hu is the new CEO, or I would say new, hired in 2019, was the former COO. Talk about this earnings call, a mind-blowing new poop product. Now, I emailed Mike this morning for comment on what this might be, what it might look like. Is it poopery? Unclear what it is, but at some point, this product is coming out from Kimberly-Clark later in the year. Mike did not return my email request for comment, but I'm looking forward to seeing it. But this ultimately set me down the rabbit's hat of what other products does this company have coming in the event. Maybe investors are just throwing this one out with the baby with the bathwater, and is some type of innovation-led turnaround at Kimberly-Clark. A couple of new products that caught my attention from this earnings call that I would call as innovative, and even though I don't use many of them or any of them. The first is the Kotex Dreamwear for ultimate overnight protection. No, I do not use that. If I did, well, that's a discussion for a different day. We have the Kleenex Allergy Comfort, not photoed there. All seem innovative to me. Also, they talked at length on the conference call about the Huggies Super Deluxe diaper in China, which Kimberly-Clark says it's the softest diaper in China. Pretty good. A couple other products, too, as you go through that earnings call. I'm interested to read this stuff. The new Poise Ultra Thin, new product from Kimberly-Clark, maybe driving some sales. And the Goodnights Youth Pant, Julie, which was interesting. Mike's saying this could hold up to three bottles of water.
Why is it interesting for me? It's more interesting for one of our producers, Pam Granda, who has an infant.
Gotcha.
And of course, nighttime leakage is a concern when you have a baby. You don't want them waking up in a wet
Well, I
bed.
just showed the hands of my life, 40-year-old but no kids, so I barely know what a Goodnights Youth Pen is. But the fact that it can hold 3 bottles of water certainly seems pretty exciting to me. Now, let's go through a couple points here, because of course, when you're looking to buy a consumer staple stock like a Kimberly-Clark, you have to think of other things besides Kotex ultra-thin pads. You have to think about inflation, and can this company pass through prior price increases? And I think that was a big concern amongst the analyst community coming off this call. Deutsche Bank out this morning maintaining a sell rating on them. Is inflation coming down fast enough? So I just walk you through this, what could be a trade on Kimberly-Clark maybe at some point. Product innovation, very important, but also that ultimately gives them the opportunity to raise prices. If you are raising prices and inflation is cooling, that equals better profits, which we did start to see a little bit from KMB in the most recent quarter, so that's a good thing. Retailer inventory levels appear to be back in line for KMP. That is also a positive thing. And again, hat tip to CEO Mike Hu. I have not talked to him in a little while, but he was the former COO of Kimberly-Clark, and he has led the company, I would say, successfully through the pandemic when we all needed these products, couldn't find them in the stores. Who else better to be running a company during a pandemic than a guy that was the COO of a company and helped engineer a lot of their supply chain efforts? My take is this on a company like Kimberly-Clark. Messy category, but nicely profitable for KMB, and there I am holding. I don't think that's a new poop product here, guys, from Kimberly-Clark, but I'm excited to see what they have coming to market later this year, and maybe it will help lift their margins. But Mike, get back at me. I'm very curious what this is.
Maybe they're going to make a bidet.
Maybe.
Maybe they'll be wiping up a few quarters.
A messy category, but prioritizing cleanliness and hygiene. Guys,
smells good to me.
Yes, indeed. Coming up, we'll get some key economic data on the housing market. That's on the other side of the short break. Welcome back to Yahoo Finance. It is Thursday, January 26th. I'm Brad Smith alongside Brian Sazi and Julie Hyman. Let's bring you some breaking data that we're seeing on housing this morning with the major averages mixed as of right now.
Yeah, we're talking about new home sales for the month of December coming in at an annual pace of 616,000. That's just about 4,000 better than estimated. But it looks like that there was an increase in new home sales month over month as a result perhaps of some revisions. 2.3% increase versus the 4.4% decline that was estimated. Got to dig into these numbers and figure out what exactly happened there. There must, as I said, there must have been a month earlier revision. We know that the housing market has been a little bit challenged here, and that has been reflected particularly in the new home sales numbers because in terms of new construction, there are a number of different shall we say, barriers to building new construction, particularly from a zoning perspective around the country.
Well, housing affordability has gone way down, of course, with the rise in interest rates. And I think back to earlier this week, we got a report from NerdWallet saying 2/3 of people surveyed in that particular poll are looking for a housing market crash, or it just really goes to show how fast sentiment in housing has turned, because this rise in rates have really made it unaffordable to buy a home.
Just to give a little bit more clarity on the data here. So the revision lower for the November number took it down to 602,000. So that's why you then saw a month over month increase. However, if you compare December 2022 with December 2021, you're talking about 616,000 last December versus 839,000 the prior December. So that gives you a sort of a more sharp picture of what we have been seeing over time in the housing market, guys.
Yeah, keeping an eye on shares of companies like Toll, Lennar, of course, all of these companies that have to do with delivering on some of those new homes that take on construction projects. And for Toll stock, they're holding on to gains here on the day by about 1.8%. And then additionally, just checking in on KB Homes very quickly while we may as well here. That's up by about 1%. You've got a good look at all of them across the board. So seeing green pretty much across some of those home builder staples, if you will. But it is, again, this larger question of how will they continue to burn through some of that backlog as well that they have of existing orders with some of the new homes.
And the housing numbers out this morning are only part of the wider picture for home buyers, with economic choppiness hitting communities across the country differently. Let's look at some of those regions and talk about what's going on broadly as well. Danielle Hale is joining us, chief economist at Realtor.com. Danielle, thank you so much for being here. First of all, when we look at sort of zoom out, and that number that I just talked about, that we saw 616,000 new home sales in December 2021 versus 839,000 a year earlier, that really puts into perspective kind of how much things have come down, I guess, right?
Yeah, that's right. So that's a decline of, as you said, over 20%. It's very close to the declines that we've seen in existing home sales, over 30%. So make no mistake, the housing market is transacting at a much slower pace than we saw 1 year ago. Now, that makes sense when you consider how much has changed in the housing landscape. Mortgage rates have gone from 3% or so, a little roughly around 3% in December of 2021, all the way up to over 6%, close to 6.5% in December of 2022. So that is a huge change in the way that financing costs for buyers, and that has affected their monthly payments and affordability. And while incomes are up, they are not up enough to compensate for those higher costs in housing, and that's why we're seeing the transaction pace slow.
Danielle, we're seeing really layoffs start to spread throughout corporate America, notably in the tech space. Are you seeing any key housing markets just start to outright collapse?
Well, we haven't seen an outright collapse, but I will say that in some of the markets that we track on a regular basis, we are seeing mild year-over-year price declines. And some of these are markets that have pretty significant contributions from the tech sector. Austin is one, for example, where we've seen mild year-over-year price declines. Phoenix, another area in the West that has been influenced by folks leaving from California and relocating. So it does have a tech sector influence as well. Now, I will say, these housing markets also saw significant price increases. So the mild declines that we're talking about, 2 to 3%, still mean that home prices are well up over pre-pandemic levels. So it's still pretty expensive in those markets, just down a little bit from the peaks.
Danielle, when people couldn't afford to perhaps purchase or finance their home or that new home, they went back into the rental market. For the renters that are out there, though, they felt the squeeze of that as you had a flood of potential buyers now coming back into that rental market and staying for longer, at least for this interim period of time. But on the rental side of the housing equation, have we started to see some of that price squeeze or that price increase start to at least moderate or normalize?
So yes, for renters in the market, in fact, today, we've got new rental data for December 2022. And what we see is that rent growth is down to 3.2%, which is the level that we saw right prior to the pandemic. So after declining and then skyrocketing, rent growth has moved back to a more normal pace for renters. That said, rents themselves are still significantly higher than they were before the pandemic. And for first-time homebuyers in particular that you talked about, making that trade-off of do I continue to rent or do I decide to buy, in 45 of the 50 markets that we studied, it is a much better decision to continue to rent if you're just looking at those monthly financial costs. You're going to see a much lower cost to rent as opposed to buying. And the differential is actually biggest in some of those tech markets. So the Austins and San Franciscos of the world, where, despite the fact that home prices may be slowing or in some cases declining, the rent buy trade-off is still tipped very heavily in favor of renting.
Now, Danielle, you guys just came out with a report on forecasting the 10 best markets for first-time homebuyers specifically in 2023. And besides the fact that I think I've only ever heard of one of these towns, what do they have in common? I mean, are people actually going to these various places?
Yeah, so these are places within metro areas. So the specific place name you may not be familiar with, but Moore, Oklahoma, for example, is in the Oklahoma City metro area. DeForest, Wisconsin is in the Milwaukee metro area. So they are little pockets of affordability within these broader metro areas where the housing market is expected to do relatively well. You'll notice there is a eastern shift to these markets in the sense that markets in the South, the Midwest, and the Northeast have more affordability. And so we're seeing more opportunities for home buyers in those markets. The other things that these markets have going on are a pretty good share of the population is young in that first-time home buyer age range. So first-time home buyers in these markets will find companionship, lots of other young people, good opportunities in housing, and also thriving local economies.
Danielle Hale, Chief Economist over at Realtor.com. Always a pleasure to get some of your time with us. Thanks for breaking down some of what you're seeing within the broader housing and home situation. Let's turn now to shares of Chevron as it seeks to lock in gains from soaring oil prices in 2022. That company announcing a share buyback program and dividend hike. Here with more, we've got Yahoo Finance's Inez Ferre. Inez.
And Brad, Chevron announced that it plans to buy back $75 billion of shares. That's triple the size of its previous authorized program. And the plan represents a little more than about 20% of the company's current market cap. Chevron also says that it will increase dividend payouts by 6.3% from the previous quarter to $1.51 per share. Now, Chevron has had record profits. By comparison, though, you may think this is really big. Well, Apple bought back almost $90 billion of shares in fiscal 22. But critics are saying, look, you're making record profits. You need to be drilling more. You need to be producing more oil in order to bring down the price of oil, of gasoline for Americans. And that's precisely what the White House said in a statement through a spokesperson, saying that for a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to executives and wealthy shareholders sure is an odd way to show it. Now, oil has pulled back from the prices that we saw last year, but look, oil companies have really kept their spending in check and have wanted to give back money to shareholders. As far as some commentary that we saw from Wall Street regarding this, JP Morgan analysts say that Chevron's buyback program could signal higher top-end guidance to come. Also expect the pacing of this buyback to be a key topic in the company's earnings call, fourth quarter earnings call, which, by the way, Chevron will be reporting its results tomorrow. So the street is really going to be paying attention to this. Right now, shares are up more than 2.5%. Last year, this stock did very well, up 50% last year. And look, guys, I've spoken to quite a few analysts saying, could the oil companies repeat their performance from last year? And certainly the consensus that I have heard is perhaps not as big as last year, but certainly energy is expected to do well. Energy companies are expected to do well this year.
Yeah, Inez, I think that's echoing some of what we've heard from investors sentiment-wise as well. Now, after Chevron, we're going to get Exxon next week, some of the other oil majors as well. Are we also expecting maybe some new cash returns from some of the others?
Perhaps we could. I mean, again, this is their motto has been to return cash to shareholders, and that's what they've been focusing on, to really keep their spending in check, to keep their capex in check, and to be able to return to shareholders. I want to point out that, by the way, Chevron has 14 buys, 12 hold, and 3 sells. These companies, I'm going to pull up the chart one more time so you can see the year-to-date chart for the energy companies and for one-year chart for the energy companies. They've really done well over the last year. So as shareholders are expecting to be paid back, we will see if others also announce something similar.
Inez Ferre, thanks so much. Appreciate it. All right, before we head to break, let's pull up shares of Adobe on some cautious comments out of Morgan Stanley analyst Keith Weiss. Says Weiss, while the quality of the franchise and a 45% pullback in the PE multiple warrant interest, our view of organic low teens EPS growth going forward looks fairly priced into Adobe stock. Building conviction in Figma's ability to accelerate overall company growth appears necessary to re-rate shares. Of course, Figma, Adobe's recently very large acquisition. Coming up, Toyota is announcing a new leadership shift. Julie's back with more on that and other top headlines next.
Here's some other headlines we're watching right now. Toyota CEO and President Akio Toyoda will step down from his post on April 1st. Toyota will become the new chairman of the board after serving as the CEO for 13 years. He'll be replaced by the current chief branding officer, Koji Sato. Sato has been heading the Toyota Lexus division and the Gazoo Racing Company since 2020. Elon Musk reportedly held talks with investors about raising up to $3 billion to repay some of the debt he accrued from his Twitter purchase. Musk's team reportedly said that if the company is successful with the equity raise, it could be used to pay down an unsecured portion of the debt that carries the highest interest rate within the $13 billion Twitter loan package. All of this, by the way, according to the Wall Street Journal. Paying off that debt would be a huge help to Twitter financially as the company struggles to keep advertisers on the platform. And some Morgan Stanley employees are facing big penalties. The bank is fining workers who conducted business on messaging services like WhatsApp. They're being fined over $1 million, which will be taken from previous bonuses or future paychecks. This is just the latest fallout after an industry-wide probe that resulted in record penalties for the banks for monitoring lapses. Since then, the bank decided to give employees training on scenarios when they should shift conversations from personal devices to official platforms. Saz?
Meta is clearing the way for former President Donald Trump, allowing him to return to Facebook and Instagram in the coming weeks. This announcement comes 2 years after his suspension following the 2021 insurrection at the U.S. Capitol. Here are the details, the Yahoo Finance columnist Rick Newman. Rick.
Well, right. So this is Trump's return to social media if he should choose to walk through this door. But whether he will actually start posting on Facebook is another question altogether. And the reason for that is that Trump is committed to posting on his own social media platform, Truth Social, which is the company that he formed after he left office because he was banned on Twitter and on Facebook. So Trump is obligated by the terms of the merger deal with a SPAC, a company that is supposed to take that public. That deal has been delayed, though. So it's a conundrum for Trump because if he goes back on Facebook and Instagram, or on Twitter for that matter, he'd get a much larger audience than he gets on Truth Social. But he would basically be dooming Truth Social, because what's the point of going to Truth Social, which is built entirely around Trump, if he's on these other platforms? So if we just look at this, the stock price for the SPAC he wants to merge with, it's called Digital World Acquisition Corp. That stock has basically crashed during the last year, and it's almost back to its starter price of $10 a share. So really interesting conundrum here for Trump's own social media company.
Yeah, most definitely, Rick. And also conundrum for Trump himself, because as you say, the audience at Facebook is bigger. And from what I've been hearing, it sounds like the allure of being able to fundraise through Facebook is pretty powerful, right?
Right. So what Trump basically did when he was on all of these platforms, and they all banned him after the January 6, 2021 riots at the Capitol, he put most of his messaging out on Twitter. He had almost 90 million followers on Twitter. But then he used Facebook to run ads as a regular advertiser, and also on his Facebook page saying donate to our various political action committees and all the different ways Trump raises money. So most of that happened through Facebook, and I think that's just because Facebook is a better platform for that type of thing. So he used Twitter to sort of spout off at everybody. Those Twitter posts often just got reposted on Facebook, but then he used Facebook to raise money. So now he has these prospects again, but we should point out that when Elon Musk bought Twitter in the fall of last year, he did reinstate Trump's account, and Trump has not gone back on Twitter. So is Facebook going to be any different? I guess you could argue that Facebook is a little different, and it would not so much be in direct competition with Trump's own platform, Truth Social, but it's really not that much different. So interesting dilemma for Trump.
Well, and my other question is, how easy will it be for him to get kicked off again? I mean, Meta still has rules, Facebook still has rules, and how much of what he typically spouts over on Truth Social would violate the current rules at Facebook?
Right. So I think this whole process we've been through during the last 2 years, which is both of these platforms kicking Trump off, they got a lot of flack for kicking Trump off, but they stuck to it for over a year. What Facebook did is they convened a kind of an expert panel to say, what are the guidelines for when we should suspend the account of somebody as prominent as Trump? And so far, they seem to have worked through that. And now they are saying they have guideposts or guardrails for when they will suspend the account of somebody like Trump. So clearer guidelines about when something would cross the line and require a suspension. And it could be I'm sure there probably are different gradations of suspensions, such as simply blocking a single post because it's inaccurate or hostile in some way, or perhaps might be interpreted as inciting violence. So you could just suspend a post or block a post, or you could just block the account, and then you could block the account for a day, a week, a month, or permanently. So Facebook is suggesting that they have worked this through, and they have sort of a gradation of guidelines about how to handle an account like this. But we're not going to know that, of course, unless Trump actually gets on there and starts posting.
Yahoo Finance's own Rick Newman going to be tracking whatever that first post is from Trump on either of the platforms. Thanks so much, Rick. Appreciate it. Coming up, smartphone shipments, they're hitting a 10-year low. Dan Halley, he's got the details next. Welcome back. Global smartphone shipments slumped in the fourth quarter of 2022, that is, according to market research firm IDC. The holiday season is usually a busy shopping period. Inflation and economic uncertainty weighed heavily on consumer demand, resulting in an over 18% year-over-year decline. That's the largest dip ever seen in a single quarter. Yahoo Finance's Dan Halley has all the details. He joins us here on set. Dan, what do we know?
Yeah, so this 18.3% year-over-year decline, that means that the number of units shipped came out to about 300.3 million in Q4. This is especially troubling just because this is usually the time of year when people are spending big on electronics, smartphones. You usually see big sales. And so you would imagine that these companies would then have, a good quarter, but clearly we're seeing pullback based on that. Shipments dropped 11% on the year. That's the lowest annual shipment total that IDC has seen since 2013. That was 1.21 billion units. And you can see here some of the top three. Apple dropped 14.9%. Samsung dropped 15.6%. Apple's still the leader there. And then Xiaomi, they dropped 26.3%. It's telling because we've also seen this in the PC market. I believe, according to Gartner, I actually have the information here, they saw a massive decline, 28.5% decline in Q4 worldwide PC shipments. That was the biggest decline since they started tracking in the mid-1990s. So these are just, it's not to say that, we're seeing the actual shipments revert to 1990s numbers. It's that the declines are so great because we had seen such huge numbers of devices being shipped out. The demand was there, and now it's just not. Look, people don't buy smartphones like they used to. It's not like every 2 years I go into a Verizon or T-Mobile. I almost said Sprint. They don't even exist anymore. One of those stores, and you pick up a new phone. It's those plans have largely gone away. So you buy a phone every 5 years, every 4 years. So it becomes more difficult for these companies to keep up this pace. But what we saw last year was just people needed new devices. They wanted new devices. The pandemic was not fun, and they wanted to get something good. Now, with all the economic uncertainty, they're definitely pulling back. So you can kind of take this for what it's worth as far as the exact numbers. Apple reports next week. We'll see what that means for iPhone sales, but the projections are for not a fantastic quarter for Apple.
And the PC numbers that you mentioned are more relevant probably for a company that's reporting after the close. That is Intel, right? Because I don't think of it as a smartphone chip maker, really. It's more other
they tried,
types
not very good.
It's more other types of devices. So what are we looking for from Intel?
Yeah, so for Intel, we're looking at potential revenue of $14.4 billion expected. That's down from $19.5 billion in Q4 last year. Adjusted EPS, that's expected to be at 19 cents. Down from $1.09 last year. And it's just, the hits just kind of keep coming. The only place I see a potential jump is their network and edge business. That could be $2.2 billion versus $1.1 billion last year. But client computing, that's people that buy, PCs, things along those lines, $7.4 billion expected versus $10.1 last year. And then the data center and AI, which is really where investors want to see growth, that's expected to be around $4 billion versus $7.3 last year. So it's not looking good for Intel. I had their numbers up a few minutes ago. For the year, the last 12 months, they're down 41%. We were looking at NVIDIA along those lines being that bad. They're only down 12% now at this point. Qualcomm 19%, AMD 32%. So, you can see that Intel still really hurting there, and they're trying to turn the ship around. They're trying to build those fabs. They're making deals to have other companies build at their fabs, but it doesn't seem to be enticing investors very much with the poor performance.
An important earnings call from Intel coming up. Dan Halley, thanks so much. Appreciate it. And we'll talk more about smartphones and chips with Intel CEO Pat Gelsinger in our What Just Happened special broadcast tomorrow. Please do tune into that one. Coming up, Levi's jeans are proving to be somewhat recession resistant. Chief Growth Officer Harmeet Singh, you see him on the screen right there. He'll join us next. Levi's is looking to go beyond jeans, I should say. The apparel maker saw 10% growth in its business outside of denim bottoms in the fourth quarter, making up nearly 40% of the company's 2022 revenue. Levi's CFO and Chief Growth Officer Harmeet Singh joins us now. Harmeet, a little bit longer title there for you, and a new title, I should say. Why that title change? We've only known you as the CFO of Levi's. What will that allow you to do?
First, good morning. Happy New Year to you, Brian, and thank you for having me. I'm both humbled and excited at the expansion in the role and, the opportunity, given the tremendous opportunity in front of a portfolio of brands. I've always believed that CFOs that drive profits by, having a growth mindset can create a lot more stakeholder value. And the role essentially, allows me to directly work, with Chip, Michelle, the executive team, and the board in delivering and allocating resources to deliver our longer-term targets. We are a $6.5 billion company. We feel and believe and are confident we can get to $9 to $10 billion. We have 3 wonderful brands. We can add, more brands in our portfolio, and then diversify. We've done a great job diversifying, as you said, outside of pure denim. And so, we want to be the best apparel company there is in the world. And to do that, diversifying, especially with the tailwind of casualization behind us, I think is a big opportunity for us.
Harmeet, I read your earnings call. I read the transcript a couple times, and I came away thinking, are skinny jeans just recession resistant?
Yes, they are. We are a democratic brand. We have something for everybody. And, I think I went on CNBC for the first time sometime in 14 or 15, and the first question I was asked is skinny jeans dead? I said no, and it continues to be the same. So, we sell a lot of skinny. I'm wearing a 5'11", which is a slimmer fit. Our looser, baggier fits, are a home run and continue to grow. And so, there's something for everybody, and whoever wants whatever style. I wore the baggy yesterday. I've worn the slimmer fit today. And so it just keeps my wardrobe fresh and my look fresh.
Yes, I see you're not wearing the Canadian tuxedo that you sometimes join us with, Harmeet, the jean jacket with the jeans. But what about just in general, though, the sort of decline that we're seeing overall in demand for denim, which seemed to hurt in the quarter? What do you think is going to turn that around? Is it going to be new product? Is it going to be changes in trends? How do you and how much control do you have over that?
Yeah, sure. So, we just reported a great quarter, a wonderful year. We grew 12% when the category was up low single digit. And that's largely because, we're a very diversified business. Our market share in 22 was up again. It's been up 5 out of the last 6 years. So as market leaders, it's our responsibility to continue to grow the category. And we're growing, many times the pace of the category, as our results have demonstrated. I think to your question about, what keeps it going is relevance. Having products that the consumers love. Our direct-to-consumer business, for example, was up, 6%. If you take Russia out, it was up 10%. In quarter 3, and our holiday sales on DTC was also, 10%. So having relevant products, having something for everybody, 23 is the 150th anniversary of the 501. The product that changed everything, that created denim, and so. We're leading from front. We're putting money where our mouth is. We've got wonderful styles, and I'm going to tease you with saying that there's a lot coming, starting with the Grammys next week in terms of marketing and product news on 501. And that should have a halo effect on both our styles as well as the category.
Harmeet, I got to be brief because I have 2 questions. One's a follow-up on what you just said, but the first one, what percentage of SKUs would you say are selling at promotional levels right now?
Yeah, I'd say, we track percentage of sales that we sell on full price. And I would say on promotion, probably 10, 12%, and it varies across the world. I mean, there's some markets where we lead by a mile. and we don't have to promote as much. Mexico is a great example. And some places where it's fairly competitive. The U.S. is a fairly competitive market. And our view on promotion is, don't lead with promotions, lead with the product, but don't be uncompetitive. And so, my personal perspective is be smart in promotions. I've been in retail for a long period of time. I've seen different levels of promotion, and it's not always offering a pure discount. It's offering a product at a relevant price point, depending on the circumstances. And so our retailers around the world are promoting smartly. And, I just talked about our direct-to-consumer results during the holiday period, which is fairly promotional. And it's best reflected in our gross margin. Our gross margin for the year in 22 was up 380 basis points relative to 19. And so, as we think about 23, we're also talking about growing gross margins when everybody probably contracts. And that is because we have relevant product, promoting smartly, and executing really well.
And then a second question, follow up to what you just mentioned in that international kind of equation and the calculus that you run over at Levi's. Within that calculus, what was behind the decision to remain in Russia?
We have suspended operations in Russia.
Understood. Okay.
Right. And we have a few outlets that are still open, essentially because we had 800 people on the ground and we have to exit leases. We have to, exit people, and we need to, run an operation that allows us to generate cash so we can, exit with our values high and be fair to both the landlords as well as our employees. But our operations in Russia are generally, in a majority of operations are suspended.
Harmeet, could you explain to me what is happening over at Dockers? This is, I believe, the third quarter in a row where sales have just, I think, surprised a lot of folks, over 20%. Or khakis just back in style?
Yeah, khakis are back in style, but it is not only the third quarter, Brian. It's the second year where we've grown close to 30% year over year. And so Dockers is back. The management team is really focused on turning around Dockers in our growth algorithm. We have said Dockers will grow in the mid-teens from here on. And essentially what we did a couple of years ago to build a company that can have a portfolio of brands is we carved out Dockers, and the management team that runs Dockers essentially only focuses on Dockers. They're compensated on Dockers. We run it like a private equity runs, a portfolio. And that allowed us to go and buy Beyond Yoga. And I think the opportunity is, pick up brands that are subscale, but wonderful brands, and scale them like we've done Levi's. And I think what Dockers is doing is taking a page of the Levi's turnaround, which is growing, our direct-to-consumer business, diversifying outside the U.S., and it's a wonderful team that's doing a fabulous job.
Okay, so just very quickly here, what's the greatest leg of the growth opportunity for Levi's going forward? Is it still jeans? Is it khakis, or are we talking yoga here?
Yeah, no, I think, a company that has a portfolio of wonderful, iconic brands that, scale. I think Levi's as a brand, making it more lifestyle, more of a head-to-toe look, and diversifying a non-denim bottoms business, which I think, Brian, you referred to as 40%. That grew 10%. And, continuing to grow that. I think the opportunity is huge. For example, our tops business was up 12%, and we are underpenetrated. Our women's business last year was up 13%, and we are underpenetrated. We're just starting on athleisure. And Dockers is, still fairly small and not a $1 billion brand. So, my view is we need to get a higher share of your closet. And there's huge opportunity. We don't have 100% market share in any of the categories yet.
Enjoy that 49ers game. Levi, CFO and Chief Growth Officer. I swear, Harmeet, I will get it. I will get it right eventually. Harmeet Singh, always good to see you.
All right, folks. Have a good one.
You too.
Bye.
Coming up, we'll speak with ServiceNow CEO Bill McDermott on the back of that company's earnings. We'll be right back. ServiceNow appears to be defying the broader tech slowdown that has unleashed a wave of layoffs across the sector. At least that's one takeaway from the company's latest earnings. Let's bring in ServiceNow Chairman and CEO Bill McDermott. Bill, always great to get some time with you. Love this line in the earnings call last night. You said ServiceNow is the safe harbor in the proverbial storm. Break that down for us. Why do you think that's the case?
Well, ServiceNow is a beyond expectations company, Brian. The main reason is we have the platform for end-to-end digital transformation. So as customers navigate the difficult macro, on one hand, they need to be highly efficient, they need to automate their business and do things at a super efficient level in terms of taking costs down. At the same time, they know they have to run a digital business. 98% of the CEOs out there have a digital-first strategy, and we're the company that can enable them to reorient business models and grow. And all of that is done on one common platform for end-to-end digital transformation, from IT being the business strategy to taking care of your employees and customers, and even having real people like us build applications on a low-code platform. So we are that company that does it all, and we have the platform that matters right now.
For companies that are kind of coming to grips with that reality that they do have to continue to spend, and ServiceNow being a beneficiary in some of those categories, I suppose, where and kind of to what extent do you see them scaling up in order to safeguard and actually protect the investment that they've already made?
It's a great question, Brad. Lots of customers right now are realizing that at the peak of the hype cycle in the pandemic, they simply invested in a lot of point solutions. And one CEO recently told me they can't afford 1,000 points of dim light. They really need a cohesive plan on a trusted platform. And in that case, they actually weren't increasing their spend. They were simply doing away with or lessening things that didn't matter, so they'd have free capital for things that do. And that's what's really important about ServiceNow. You can take money and use it for better purposes by eliminating lots of the point solutions that are now consolidating on our platform, or simply put our platform in to reside above these outdated systems of record to get a huge productivity bump, a great consumer-grade user experience, and obviously drive productivity and growth. And that's really what is happening. There's about 4 or 5 platforms in the whole world of enterprise that matter, and we're one of those standard bearers.
Hey, Bill, it's Julie here. You have said that you're not going to be laying off people. What's the difference between you and some of your competitors on that front? Is it that you're just maybe you didn't beef up as much, when your competitors were, or you just think it's important to keep those people on and not let them go? What's the differentiator?
Great question, Julie. We're growing faster than all of them. I mean, this is a company that's the fastest growing enterprise software company in the world. They say you're world-class when you grow at the rule of 40, meaning more than 20% revenue and free cash flow margin, another 20%. If it adds up to 40, you're world-class. We're growing at 58.5, nearly the rule of 60. So this growth is all organic. We're fueling the fire with great engineering. We continue to hire the best engineers in the world, and we continue to hire the best go-to-market professionals in the world that can take care of our customers, continue to keep them loyal. We have the highest loyalty scores in the world, and obviously grow within our same account or net new logos as we expand the franchise across the world in every industry and across every persona in every business. So there's a lot of growth on here at ServiceNow, and we need the people. And furthermore, I think you bring up a great point. We were highly intentional, even with the peak of the hype cycle in the pandemic. If you got into ServiceNow, it's because you were a 9 or a 10. We hired the very best people, because we don't hire people to fill jobs. We hire people to build careers and build a culture and build a great company for the ages. So we need the people, we believe in the people, and the people love being here. That's why we were Glassdoor's top pick in our industry.
Bill, key to that building ServiceNow and building the culture has been you over the past few years since you joined the company. You recently added the The title is chairman. You really also made a key promotion inside the company, which you talked about in the earnings call last night. How much longer do you see yourself as CEO of ServiceNow? You've been doing this for a while.
I'm just getting warmed up. I'm just getting warmed up. So I'll be here for the duration. I came in with a vision to make ServiceNow the defining enterprise software company of the 21st century, and I intend to see that through to its entirety. Now, at the same time, I think very good leaders build great teams. And I've got a great president and chief operating officer in CJ Desai. He's richly deserving of that promotion. And the reason for that is he uniquely understands how we build a great platform, but also how you take that platform to market and make customers super successful, super happy, and super interested in expanding their business on ServiceNow. So what we want to do is build a culture where everyone really understands that great products and unbelievable, unmatched customer centricity not only gets you promoted, but it creates an enduring company. And that's what we want to be, the defining enterprise software company of the 21st century.
For as great a company as you are running and as that you're telling us the environment is for the company right now too, Bill, I got to wonder, when you see shares down off of the 2021 highs by about 33%, still, even with the move higher here early year to date, you've seen some activist campaigns within the ERP landscape or even the B2B landscape right now. And thinking of Salesforce particularly, do you get concerned when you see some other companies that perhaps have a solid portfolio of clients, a solid offering that they take to market, getting nibbled at by some of the activists out there?
Well, I don't get concerned about that for ServiceNow, because what they do is they go into these other companies you're referring to and they say, hey, this is the benchmark. It's ServiceNow. ServiceNow is growing 3, 4, 5 times faster than you. ServiceNow has a margin profile that is substantially higher than yours. ServiceNow is expanding their customer base, their employee base, and their free cash flow margins. That's the benchmark. Now, how do you get to be ServiceNow? They're not saying to ServiceNow, how do you get better? Because they already know we continue to get better. So for those companies that are looking at ServiceNow as the benchmark, I think it's a privilege and an honor, and that's why we intend to be the best run business in the world.
ServiceNow CEO Bill McDermott. Bill, always appreciate the time and the insights, and especially looking around the industry, getting your take on it as well.
Thank you very much for having me.
You got it. Guys, coming up, MasterCard is calling consumer spending resilient on the back of its earnings. We're going to discuss that next. Welcome back. It's time for Cup of Time. 3 stories, 1 minute each. We start with this. MasterCard earnings, they cashed in above expectations as the CEO flexed remarkably resilient consumer spending despite economic uncertainties, but warned that revenue growth would slow more than expected. You're seeing shares down right now by about 1.25% here, but for MasterCard and that slowing growth that they are warning of, I think that this is kind of a shot out there for some of the banks, or some of the firms rather, analysts that had been really bullish on Visa and MasterCard and leaning on consumers at a time of their own spending uncertainty, leaning on some of their credit spending as well.
Yeah, well, we did see a little bit of a slowdown in the credit card spending at the various banks when they reported, Brad, a couple weeks ago. You're right on there, so not necessarily surprised. And of course, we have to watch for our American Express. They report their earnings before the bell tomorrow morning. But I think there's another story starting to emerge at MasterCard. And Julie, I was thinking back to a conversation we had at Davos, just off the cuff. We had a little drink here with MasterCard CEO Michael Maybach. Just him driving a better culture at the company. I think that will be very telling if we do go into a recession. That I think that would be very helpful just to improve your culture. All right, and job cuts are expanding beyond tech. Dow Inc. is the latest to announce layoffs, shedding 2,000 workers globally as it looks to match its cost structure with the current economic environment. The vibe this week, we had 3M earlier in the week saying they're laying off people on the manufacturing front. Dow now as well, and the vibe continues to be these layoffs are spreading beyond tech.
Yeah, I mean, they're talking about macroeconomic challenges just like everybody is talking about here. At the same time, again, this is a larger percentage than at some of the other firms that we're talking about. 2,000 jobs being cut. There are about 35,700 people who work at the firm. So it's a higher percentage, but still not a huge number. It's just this sort of rejiggering at the margins. And you also have to wonder, as we talk about all these companies, how much of it is for show, for lack of a better word? Not sort of the bigger cuts, but like how much of it is throw a bone to the street, we're cutting costs, we're active, we're being proactive in this environment.
Part of it's the timing around it too. This is a time of year where we typically come after some of the end of year reviews, things of that nature internally. However, for all of this to be kind of delivered at the same time, it's not just all end of the year reviews at these companies.
Right. Yeah. Blackstone has come up short of the $1 trillion mark in assets under management for 2022. That's a year after CEO Steve Schwarzman accelerated his timeline from the original goal of 2026. They did not meet that particular measure there. The stock, though, as you can see, is trading higher right now. Quarterly earnings did top analyst estimates, and the company also declared a dividend of 91 cents, although that was a little lower than expected. But the share's getting a pop, it looks like, from the earnings beat.
Look like a better quarter, at least to me, from BlackRock when they reported a couple
Blackstone.
weeks. I know, but relative to BlackRock.
Blackstone versus BlackRock.
Yeah, but I think BlackRock had a lot more challenges in various parts of the business, notably expenses just too darn high.
Yeah, stones versus rocks. And in this one, they said that they were able to kind of navigate one of what they're calling the most challenging market backdrops in history here. Well, it could get a little bit more challenging should their customers as well, should the expectations come true about what could be a second half recession this year as well.
Yeah, I mean, they're pretty different. BlackRock, much more of an asset manager, Blackstone, much more weighted toward private equity. So telling us a little bit different things, perhaps, about different parts of the economy. All right, we got to leave it there. Rochelle Lacufo is going to have you for the next hour of trading and do a deeper dive into those Tesla earnings. She'll talk to Ross Gerber. That'll be interesting. You don't want to miss that.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Tesla delivers, sort of. The company reported record revenue and beat earnings estimates, sending shares into rally mode this morning. But Elon Musk warns that there are uncertainties ahead. We'll break down what Wall Street is saying in just a bit. Plus, layoffs mount in tech. IBM and S&P, SAP, just the two latest companies to add to the wave of tech layoffs as businesses cut back after rapid growth during the pandemic. And of course, Southwest was under a microscope this quarter, thanks in part to the massive holiday fiasco that resulted in nearly 17,000 flight cancellations. We'll zoom into their quarter later in the show. But first, let's get a check on how the markets are faring an hour and a half into trading here. We see a mixed picture here, struggling to find some direction. The Dow, they're just down about 0.33%. They're down about 98 points. The S&P 500 there, as you see, they're oscillating into positive and negative territory, relatively flat. And of course, the tech-heavy NASDAQ there, just slightly up there, about 0.33%. Keeping an eye on what's happening with annualized GDP, coming in better than expected, but slower than the previous 3 months. So let's check on how that affected also the Treasury yields as they await the Fed this week, coming up next week. You have the 5-year, 10 and 30 all in positive territory. The 5-year up 0.8%, similar for the 10-year, 0.9%. The 30-year, these longer-term yields though, up just about 0.33%. All right, well, Tesla out with a beat on the top and bottom line in its latest quarter, with the stock seeing a pop this morning on the back of its earnings release as the EV maker eased investor fears of weaker growth. However, the view on Tesla among analysts shows not all is smooth sailing. Here with the details is Yahoo Finance's Pras Subramanian. Obviously, a lot of people were watching this to see what would happen.
Yeah, Rochelle, big earnings and big call last night. Analyst reaction mixed. Nice pop today in the stock. You have people like Dan Ives calling it the Super Bowl for Tesla. But you're absolutely right, though. Among others, there's been some sort of kind of consternation about what this means. So, Goldman's Mark Delaney reiterated his buy rating here, claiming Musk's comments on January orders being to date the strongest ever was, quote, the most important takeaway from the call, and I tend to agree with that. On the flip side, Tony Sacconaghi, AllianceBernstein, a noted Tesla bear, reiterated his underperform rating there, saying he's torn after the call in the earnings statement. He's concerned about margins and whether demand can be sustained at these levels. Finally, Citi's Itay Micali, he raised his price target to 146, claiming the call gave some relief to the bulls. But there are still concerns like margins and a big free cash flow miss last night, which is actually kind of flew under the radar. So kind of a mixed bag here from the analyst point of view. But the stock, I mean, there's no discussion. The stock's up 10% today.
And we knew that margins were going to be a big theme this earnings season, but you mentioned things flying under the radar. What are some of the things that one might have missed from Tesla's earnings?
There was a lot on that call, from Cybertruck to FSD and things like that. But I think under the radar, some stuff. Musk talking about how he wants to maintain strong volume growth while maintaining margins. That's kind of tough in an environment right here where margins are under pressure. Prices, inflation has been rising. But maybe if prices do come down and you have ramp ups in places like Berlin and Giga Austin, maybe you can have that magic sort of mix of rising margins but lowering prices. Another nugget that he kind of mentioned that sort of flew in the radar was, talking about who could challenge Tesla down the line. Musk said it could likely be a Chinese competitor because they, quote, work harder and work smarter than anyone else. Thought that was interesting. Kind of a diss here to American and European automakers who are sort of, kind of coming at Tesla on domestically here, but also in Europe too.
Indeed, a bit of a dig there. I think you're right there. Pras Subramanian there for us. Thanks so much. All right, well, we're looking to the skies now as several major airlines report their quarterly performance, with Southwest experiencing the most turbulence after its holiday travel debacle serves as a pain point for the U.S. airline. We're here to discuss is Mike Boyd, president of Boyd Group International. I mean, we were looking at an $800 million pre-tax hit, which really affected earnings. They had an earnings miss because of that. Still, though, a revenue beat. How would you characterize where Southwest is, though? Because all that focus really on that loss.
This is the most difficult time they've ever had. People have always relied on Southwest for three things: low fares, lack of fees, and enormous public support. The low fares aren't there anymore. They price reasonably. Other airlines have done away with fees, a lot of fees. And now, after what happened over the Christmas, you had millions of people who were really badly hurt. So they can't rely now on the fact that everyone loves us. They've got to pick up from bootstraps and try to rebuild their airline as a going concern for the consumer.
And Southwest really does have some of the most loyal fans. I think you compared them to Grateful Dead groupies, but obviously a bad experience can change a lot of that. And we did see President and CEO Bob Jordan recognizing how much they'd let their customers down. And they talked about these cancellations, though, and slower bookings continuing in January and February. They even said in their SEC filing, based on current revenue and cost trends, we currently expect a first quarter 2023 net loss. However, we are encouraged by the current booking trends in March of 2023. Our 2023 plan continues to support solid profits with year-over-year margin expansion for the full year 2023. Would you be as optimistic? Do you think those ripple effects are going to have perhaps gone away by then?
I don't know. I really don't. I mean, I love Southwest. Bob Jordan, I think, is doing as good a job as anybody could do. But keep in mind, you had millions of people, millions of families who had their holiday destroyed. Right now today, even with the refunds, having run a refund department at American Airlines, you can't do things normally here. When someone says they lost their deposit on the hotel, Southwest has to make that good. This is not a normal situation, or otherwise they're not going to have anywhere near the loyal support they've had before December.
And we're certainly seeing the stock price punished for that. I mean, he did apologize again in that SEC filing. And he also said that they do plan to investigate what happened and really invest in technology as well. What is it going to take then for Southwest to really regain the competitive edge, being that now it is perhaps at a more level playing field with some of these bigger airlines?
Well, right now, I mean, the warning is there. They got to fix the one system that caused all this. It's one system at one airline that caused this disaster. It is being addressed. But again, you have people out there that are saying that I didn't see grandma for the last time. I didn't have a good Hanukkah. I did not have a good Christmas. And it's all Southwest's fault. And when I asked for a refund, they only gave my ticket back. Southwest has a lot of work to do to get that back again because they're in a hole right now.
And meanwhile, you have American Airlines really touting how well they fared operationally over the holiday season. Strong demand picture, earnings beat, record Q4 and full year as well. How does American Airlines compare? Because we also saw JetBlue with record revenue as well, but it does seem to be a tale of margins.
Well, one thing too, look, flexibility is going to be everything in the next 3 years. Flexibility meaning what you can fly, how you can fly, where you can fly. Southwest Airlines has two different configurations, 137 seats, 175. Anything above that, anything below that, they really can't access. So they're going to be somewhat in a corner fleet-wise, and that's going to be a challenge as well because in the next 5 years, what you can do is look at how many markets you can operate and have multi-mission airplanes. This is something people haven't noticed, but Southwest Airlines may have a deficit there.
And what about JetBlue? Because, I mean, they saw Q4 record revenue as well, but they definitely weren't as optimistic about what their first quarter of 2023 was going to look like.
Oh, well, they need to be optimistic, but guess what? Their purchase of Spirit was not a merger. They bought assets. They're the one airline today with that, if that purchase goes through, they're going to have airplanes, new airplanes, and they're going to have pilots. Other airlines are going to look for others because they bought the assets really of Spirit, and they're going to be the best postured airline over the next 3 to 4 years to grow. And I'm looking forward to seeing how well they grow because it's going to be huge.
And how do you see the perhaps market share changing as we look at this industry and we look at some of the changes and investments these major airlines are making?
Well, the big issue we have to realize is the new world. I mean, 4 years ago, you had 8 million people back and forth between China and the U.S. That's down to 100,000 or 200,000. Now it's going to stay there. So you have to be able to move very flexibly. And if you move flexibly, that means you have to have a fleet to do that. So I would say you're looking at airlines like American, Delta, United. These are all very well-managed airlines. And same thing with Alaska. So I'm thinking that the shares are going to stay the same because airlines now are only going to fly what they want to fly. They're not chasing economics anymore. They're making the economics.
And they've clearly shown that the demand is there. We're clearly seeing the ticket prices not going down and people still willing to pay the high prices. A big thank you there to Mike Boyd, president of Boyd Group International. Thank you for joining me this morning. All right, well, MasterCard is out with a beat on the top and bottom line for the latest quarter. The CEO stating that, quote, while macroeconomic and geopolitical uncertainty persists, consumer spending has been remarkably resilient. However, the company's sales growth continues to decelerate as concerns on the rocky road ahead for MasterCard amid economic headwinds remains top of mind for investors. All right, coming up, Comcast topped estimates for the fourth quarter. We take a deeper dive into those numbers next. Comcast beat analyst estimates for its fourth quarter this morning with a boost from its broadband and wireless business. Though losses in its streaming arm, Peacock, continue to grow despite a twofold in paid subscribers over the past year. Well, for more on Comcast streaming woes, let's get to Yahoo Finance's Ali Canal. An interesting picture here for Comcast.
Yeah, Rochelle, and this is a story that we've been seeing across the media sector, right? More growth, more momentum there, but that usually comes at a pretty steep cost. And if we zero in on Peacock, Comcast saw a nearly $1 billion hit in the quarter related to Peacock, which weighed on overall adjusted earnings for NBC Universal. And on that earnings call earlier this morning, executives maintained that they expect peak streaming losses in 2023, estimated at about $3 billion. And they remained fairly confident that this is the right business model for the company at this time. We heard from Jeff Shell. He is the CEO of NBC Universal, and he said that they would not be investing as heavily as they are in Peacock if they did not expect the streamer to lift the media segment to growth over time. Now, over time, that's a pretty broad term, and Jeff Shell did warn that there are obvious macro concerns like the ad market recovery, further losses in linear cable, as well as cost cuts that could weigh on that timeline. But overall, it was very clear on the call that they are not abandoning Peacock or streaming overall. And from a strictly subscriber standpoint, Peacock did add 5 million users in the quarter to reach more than 20 million by year end. And for context there, as you alluded to in your intro, Peacock had just 10 million subs at this point last year. So more than doubling that base amid a slew of live programming, some new films like Nope, as well as further additions in original content. So overall, not a terrible quarter for Comcast. Like you said, we did see continued strength in its broadband and wireless divisions, a boost in the theme parks, which we usually tend to see there with NBC Universal, but those macro challenges still very heavy in the background.
Indeed. I mean, you figure consumers still pulling back, trying to figure out how they're going to spend their discretionary income. But you talked about some of these streaming losses. So as this continues, then, how is Comcast looking at perhaps more media giants as they explore other options to deliver those balance sheets?
Yeah, and this was specifically addressed on that earnings call since WWE, that's still being searched, chopped around for a potential buyer. And NBC Universal is WWE's largest media rights holder, with Peacock serving as the exclusive streaming home for the network. So a lot of analysts on the street have been wondering if Comcast could potentially be interested in acquiring WWE. But executives said that they are more focused on investing in their own businesses, and it would really require a lot of thought to look at outside investments. That being said, though, Jeff Shell said that they are open to bolt-on acquisitions, like more partnerships, similar to what we've seen with NBC's multi-platform collaboration with Blumhouse Productions. So that could be some M&A activity that we could see from Comcast over time that doesn't necessarily involve those big industry acquisitions. But certainly across the board, all media companies are trying to grapple with these accelerating losses, and M&A is usually the quickest option to accomplish that.
And you have to wonder what they're going to prioritize. I mean, obviously you have sports, but we also see some of these sort of big budget investments in movies as well for these streaming giants. How do you think they're going to be prioritizing things going forward?
The emphasis on the call was really Peacock, Peacock, Peacock. I do think that they are seeing a world where everything is sort of going towards streaming. More eyeballs are going to streaming. So they're going to look for a way to really utilize Peacock to help lift their business over time. So that could mean putting more live sports on Peacock. That could mean funneling a lot of those Universal productions onto Peacock as streaming exclusives, or partnering with theaters in some way. So that is the focus right now. Whether or not it pays off, especially amid this landscape that's very competitive, that all remains to be seen.
Indeed. Over time, as you mentioned there, the line to focus on. A big thank you there, Ali Canal. All right, well, in the wake of the U.S. Justice Department antitrust suits against Google, Paul Pelosi's Alphabet trades are coming into focus. The millionaire husband of former House Speaker Nancy Pelosi sold his Alphabet shares prior to the DOJ announcement. Now, the Pelosis have previously denied any misconduct, but other lawmakers are taking aim at the congressional couple's stock trading. Yahoo Finance's Rick Newman has the details. And Rick, we know that this has a lot of, it's a political football that they like to toss around.
Oh, yeah. So if on the surface, you could, I guess, infer that perhaps Nancy Pelosi got word of the Justice Department lawsuit against Google, the antitrust suit, and told her husband, who's a wealthy investor, and he said, I'm going to take advantage of this insider information and sell my shares before this news becomes public, and therefore either make money or avoid a loss. That is not what exactly happened, however. If you look at the timing of everything in question here, Paul Pelosi sold his Alphabet shares, that's the parent company of Google, at a couple points at the end of December, and Google shares have actually gone up since then. They're up by about 8%, even though they did fall back a bit on the news of the antitrust lawsuit. So if Paul Pelosi is using insider information to make money, he's actually a very bad insider trader because Google's price has actually gone up, not down, since he sold his shares. You know, this is a big thing on Fox Business and Fox News. They're saying, oh, look, here's evidence that the Pelosi's are, the game is rigged in favor of the Pelosi's. But all you have to do is look at a stock chart for Alphabet and say, wow, it doesn't really add up that way.
So then, Rick, given that then, what is the outlook for congressional stock trading? And is there even an appetite for a ban? I know some Reddit users have compared it to a bear voting to ban salmon. Is this something that they actually want right now?
Well, this is going to go nowhere anytime soon. I mean, there are periodic calls for a ban on congressional stock trading, and it gets complicated because then you have to say, well, you can ban the members themselves. That's 535 members of both houses of Congress. You can ban them from trading individual stocks. But what about family members? Would that have to extend to spouses? What about children? What about in-laws? And you get into this whole can of worms where, okay, you could ban trading by the members, but what about family members and how far do you go? So if members really did have inside information that they could make money on, there'd still be a way to do that because it's somewhere down the chain, they could pass the information on and somebody could trade it. So this comes up every now and then. It's one of those things that sounds good in principle, but it's hard to execute. If you did actually ban trading in individual stocks by members of Congress, you could still allow them to trade ETFs or mutual funds the way most ordinary investors do. And while there wouldn't be the chance to make bets on individual companies, they could still capitalize on the gains in the stock market over time. So that's a plausible way forward. Let's remember we have a divided Congress right now, and Democrats couldn't pass this when they had control of Congress, and Republicans couldn't pass a stock trading ban when they had control of Congress. So there's no reason to think it's going to happen.
I mean, it is true because I think it was back in 2020, Democratic Congresswoman Ocasio-Cortez also tried to put this forward. It didn't get traction. So interesting now to see it then flip to the other side and still not getting any traction. Are we going to just keep kicking this can down the road?
Yeah, this is not going to pass anytime soon. It's just one of those soundbite things, Rochelle, where Josh Hawley, the ambitious senator from Missouri, has proposed legislation that has an acronym that, when you put it together, spells Pelosi. So he calls it the Pelosi Act, as if Nancy Pelosi is the sort of face of villainy on this one. That's cheap. She happens to be married to a wealthy investor. It is still illegal to trade on inside information if you're a member of Congress, and there have been some investigations into cases that looked as if some member of Congress did get information. I think if you look into Richard Burr of North Carolina, there were some suggestions that he got information leading up to the COVID pandemic that he knew that we were going to be facing a pandemic before the rest of the public did, and he may have traded on that. There was an investigation. I don't think it went anywhere, but it was bad publicity for him. There have been a couple instances of members of Congress actually getting prosecuted for trading on inside information. So you're not allowed to trade on inside information, but of course it's hard to show that anybody does. So I think this is just going to be a soundbite issue for members of Congress here and there who want to gain some political points, but it's not going to, I don't see any pathway to this becoming actual legislation that can pass.
Certainly seems that way. Rick Newman, thank you so much for that update for us. All right, coming up, we take a look at ways to be better positioned in the fixed income space. Stay tuned. A boon for bonds. Fixed income set to see an additional boost as the Fed is expected to raise interest rates and is unlikely to change its course until inflation data improves. But not all fixed income is made equal. Here with more is Chip Huey, Truist Wealth Managing Director of Fixed Income. Good to see you, Huey. So as we've been mentioning there in the intro there, lots of different strategies. You have obviously active, passive, a hybrid. For people who are trying to figure out which strategy or how they should use these strategies in this environment, how should they navigate this?
Yeah, great. Thanks, Rochelle. It's great to be with you. Thanks for the opportunity. I think that there's really two main ways where we see an attractive opportunity in fixed income, two ways to approach it. So on the one hand, we have sort of the passive approach. In the front end of the yield curve, in the first 2-3 years of the curve, we're seeing some of the highest yields that we've seen in the past 15 years. And that's largely a result of the Fed's interest rate increases. And so buying individual high quality securities there, you're capturing some of the highest yields we've seen in more than a decade, but it also gives the opportunity to allow those bonds to roll to maturity and to make routine reinvestment decisions at that point. Given the economic uncertainty we've seen, that's a pretty valuable amount of optionality, flexibility in making new decisions as we get new data.
So then what are some of the ones that you're rolling out or and rolling into to really account for some of the changes expected ahead?
Yeah, so that speaks sort of to the other way to approach it, more of a portfolio or total return context. Back in late October, we upgraded our views of durations, or so longer dated fixed income, because we do see risks of recession rising as we progress through this year. And if you go back through history, long duration or longer dated high quality fixed income does tend to outperform as the economy slows down or enters recession. So from a portfolio context, we saw greater value in duration as the 10-year rose above, call it 4%, 4.25%. And that's still what we see. We recommend a few things. One, keeping fixed income simple for right now, staying high quality in anticipation of opportunities in riskier fixed income down the road over the course of the next 6 to 12 months. That will probably be a better opportunity for an entry point at that point. Right now, though, when we made that upgrade to duration, the 10-year was a fair amount higher, about 4.25. So we would be a little bit more patient for major duration moves right now. We are right in the middle of the trading range that we identified coming into this year. But if we see yields rise up towards that 4% range again, value comes back again for duration.
Now, this can be hard because obviously a lot of people, when we see the markets move with every single Fed announcement, we know that the Fed is going to continue on this road. At least we're expecting that 25 basis point hike, but still don't seem to be at that threshold where they plan on pausing anytime soon. How are you factoring in when then to extend or reduce duration on some of these?
Yeah, so we do expect the Fed to raise by 25 basis points next week, possibly 1 to 2 more 25 basis point rate hikes beyond that. And then we expect the Fed to move to a pause and to hold rates steady. And I think that one thing that perhaps the market is underappreciating, we think that it's a really high bar for the Fed to start reducing those rates. They have a tremendous amount of scar tissue from the inflation experience that we've just gone through over the course of the past 12 to 18 months. And we're going to need to see inflation data consistently cool and stay on this downward trajectory before the Fed gains comfort in potentially cutting. And right now, the market is pricing in multiple cuts by the end of this year. We're not completely convinced that the Fed won't hold steady and allow inflation to cool, and also to relieve some of the tightness that we're seeing in the labor market.
I mean, between some of the extra optimism, as you were saying, in some of these estimates as to when the Fed will start cutting this year, you also have, of course, issues over the debt ceiling. Now, obviously, we're expecting this to be resolved, but what should people keep in mind as we have this period of volatility right now?
Right. I'll say right out in the outset, because we've been getting a lot of questions about this, and it's a really important question. We do think that ultimately Congress comes to an agreement and the U.S. averts default. But if we go back to the most similar proxy to what we're seeing now, we have to go back to 2011, when it was another contentious debt ceiling debate. And what we did see is, as that deadline approached, investors grew very uneasy. Actually, over the course of about a month, the 10-year fell about 100 basis points, or 1% in yields, as investors flew into quality, right, into a risk-off mentality. And we saw rate volatility really spike around that deadline. So we do think that it is likely that we will see volatility increase as we move towards that deadline. The likelihood of some kind of brinksmanship tactics and some 11th hour negotiations could make the market feel pretty uneasy. And so that is a deadline to watch. But we do think that the worst outcomes that a lot of attention is on right now are ultimately going to be avoided.
Well, certainly good to keep that in mind, because when things start going a bit left towards that, people should keep that steady hand that ultimately Congress does always end up resolving this. Chip Huey there, Truist Wealth Managing Director, Fixed Income. Thank you so much. All right, well, new home sales out this morning showing more housing than estimated, while possible home buyers this year can take cheer in a new report from Goldman Sachs. The bank seeing housing affordability set to increase. Now, this, of course, tempered by a still challenged housing market, with new constructions held back by lagging supply chain challenges and an overall gloomy outlook for the economy, dampening demand. All right, coming up, the return of former President Donald Trump to Twitter and Facebook. We discuss the impact and the reactions around the social world. Stick around. Meta is ending former President Donald Trump's Facebook suspension, saying in a statement that his Instagram and Facebook accounts will return in the coming weeks. Though just because he's reinstated, it doesn't mean he will return. For more on Meta's decision and its impact to the social media landscape, let's get to Yahoo Finance's Ali Garfinkel. Now, we know he was also invited back to Twitter. Didn't seem to be interested in that. So where do things stand here then with Meta?
Yeah, Rochelle, I'll be completely honest with you here. I'm sort of struggling to take the temperature on this moment because on one hand, it feels almost a little anticlimactic. It's been a few years and he sort of has been invited back, as it were. But on the other hand, it feels high stakes and the takes are flying. And I think it's important to run through those takes just a little bit, because from the legal side, what we have is this renewed conversation about the definition of town square. Now, some legal experts are telling me that in terms of Trump's constitutional rights to free speech, this could be the right call on Meta's part, if you believe Meta is running a digital town square. However, to others, since Meta is a private company, this isn't a public town square they're running, it's a private business. So you already have that legal side of it. And going beyond that, it's as thorny as you'd expect. I have advocates telling me that they're worried this will increase Trump's reach through 2024 as the election grows closer. And even one professor I was speaking to was saying that we need to remember that this could give Trump a powerful fundraising tool. However, I think it's important to say Meta was very equivocal in this. They're not giving him free rein here. They've said that they will be monitoring him closely and that there will be what they call guardrails. And I will say those guardrails are very necessary. We have to remember the reason he was banned in the first place, and that was the events of January 6th.
So then, I mean, what happens next here? Because he may or may not decide to hop on these, but it's hard to imagine he doesn't get back on these platforms when you think about his presidential aspirations.
I think it's really unclear, Rochelle, right? But on one hand, it would make sense. But on the other, he has Truth Social. And we now know just because he's reinstated, though, doesn't mean he will leave Truth Social. It doesn't mean he'll return to these platforms. For instance, as you said earlier, Elon Musk reinstated him to Twitter a while back, and he has opted to stay off the platform so far. So I think where this could get interesting is it could be a huge story over time. We could see things go back. We could see renewed efforts at content moderation. One expert I was speaking to said that this was, as scary as this was for him personally, this was also an opportunity to reimagine how content moderation can work for someone with the profile of Donald Trump. In the end, though this could be a major story, there could also be radio silence.
It's true. I don't know. Trump and silence don't usually go hand in hand, especially with how much might be at stake in 2024. But stranger things have happened. We'll keep an eye on that. Indeed. Ali Garfinkel there. Thank you so much for that update. All right, well, moving to tech now. Job cuts in the industry continue to mount, with IBM, Lam Research, and SAP the latest to announce job cuts. Yahoo Finance's Dan Howley has the details. Hey, Dan.
That's right, Rochelle. We're seeing more and more job cuts from the tech industry. Obviously, it's already been stung by huge pullbacks in jobs from the likes of Amazon, Microsoft, Meta, and now we're seeing them from IBM, though not as large as we saw from either Microsoft, Meta, or Amazon, which was in the tens of thousands. This is much lower. We're also seeing them from SAP, and really the big overarching kind of message is that yeah, we hired too many people during the pandemic. We thought that this was going to be a new way of life, and so we ended up hiring for that. Obviously, that's not the case. People don't want to just be on computers forever. They want to be able to go outside, or they just don't necessarily need to be on them so much. So now we're seeing these companies try to kind of course correct after making those enormous hires. That's not to say, though, especially in the case of IBM, that they're not going to be hiring anymore. A number of these companies, there are hiring freezes at some, but a number of them will continue to hire in very specific areas, those being related to things like the cloud or, heavy computing areas. So it's not as though there's a complete stoppage when it comes to hiring in these areas. It's just that they're trying to now cut back on what they did hire. And, we had a chart a few days ago basically showing the percentage of workforces for different tech companies that were hired during the pandemic versus who were being let go now. And it seems as though they're not letting go as many as they hired. So obviously, we can see here Amazon with that 18,000, Alphabet with 12,000, Meta with 11, Microsoft with 10, and then, down and down from there. But, it seems as though this is something that is just going to basically roil the tech industry, perhaps for the next few months.
And as you're talking about there, a lot of overhiring, but some of these big layoffs, are we at the end of perhaps some of these major layoffs? Do we expect more to continue as we still then see people sort of shifting to different tech companies and sort of rehiring them?
I think, this is basically what we're going to have from the companies that have announced so far. Obviously we have Intel announcing their earnings after the bell. There was some rumbling about them potentially having layoffs as a result of the drop in PC demand. That's really suffered. People purchased their computers during the pandemic. They don't need to buy them again for perhaps another 5 years. So that's really hurting them a good deal. So I think we could hear something from the chip space. That's, we haven't really heard much from there. We've heard that there are hiring freezes or there are slowdowns, but nothing as far as layoffs. I think that might be the next place we start to see it.
All right. Well, thank you for that update there. Dan Howley there for us. All right, well, be sure to tune in at 11 a.m. Eastern tomorrow. We'll spend the full hour diving into the layoff story that are rippling through the tech industry in our latest episode of What Just Happened, a show where we break down the top trending story of the week. All right, coming up, Tesla on the rise following a strong fourth quarter earnings report, but is now the time to buy? We talk with a Tesla bull next. Tesla topped analyst estimates in its latest quarter, lifting Tesla shares higher this morning. You see they're up about 8.5%. That's after the stock took a beating in 2022, with investors worried about Musk's Twitter distraction. However, for those questioning the brand image impact on Tesla hitting demand, here's what CEO Elon Musk had to say on the matter.
So I've got 127 million followers. It continues to grow very rapidly. That suggests that I'm, reasonably popular. I'm the most interactive account, social media account, I think, maybe in the world, certainly on Twitter. And that actually predated the Twitter acquisition. So I think Twitter is actually an incredibly powerful tool for driving demand for Tesla.
Well, for a closer look on Tesla and the road ahead, we have Ross Gerber, Kawasaki Wealth Investment Management. Good to see you, Ross. So I want to ask you about what Musk said there, because popularity on Twitter doesn't necessarily equal demand. What do you think about that correlation that he's making here?
Well, I think it's a little bit naive in the sense of, a lot of people follow people just to watch the train wreck, kind of thing too. So I don't think all my followers are actually fans of mine, to be honest, on my Twitter account. So, you got to be careful with that. But I think his perception of Twitter's reach is a little off. Twitter actually has very limited reach, when you're talking about domestic viewers, like on the general public. In fact, most of the people I know don't use Twitter at all. So I think that's one of the reasons I've been pushing for Tesla to really start doing some traditional advertising and marketing, because I do think he is incredibly popular and successful at using Twitter as a tool for marketing Tesla. But there's also been some negative with him using Twitter as a tool. And I think that, once again, most people don't use Twitter, and Tesla's price cuts, if everybody knows about it, they're going to buy Teslas.
And I mean, you have to wonder who he's listening to at the moment when it comes to investing here. I mean, the earnings are speaking for itself, though, with this incredible beat here. But then, do you think that's enough to silence the bears at the moment, enough to say, look, it hasn't been enough of a distraction to really damage Tesla's business?
I think the thing here that really impressed me is I really do think Elon has been very preoccupied with Twitter, but the Tesla team deserves the credit 100% for this quarter and the achievements that they continue to make. The Tesla team, and you're starting to see a broadening out of the different characters who work at Tesla, and starting to get to know these people who have really done a great job despite a lot of adversity last year. And as we go into this next year, it's going to be Tesla's best year ever. So I give credit to the Tesla team, from Martin, Martin Viace, in charge of investor relations, poor guy, to all the different operators, Zach and Drew, and the whole team there, just really, really executing and working hard. So I give them a lot of credit.
And Ross, I want to toss to this soundbite we have here from when you were on Yahoo Finance in December, sort of really about navigating this space with Elon. Take a listen.
I'm an investor in Tesla, and I'm going to stay as an investor in Tesla. And I represent my investors who are invested in Tesla and the Tesla community, and we care about Elon. But when your friend goes astray, you can either be the type of friend who doesn't say anything, or you say something and maybe that person doesn't like it so much, but hopefully he understands that I'm trying to do what's best for everybody.
So then, Ross, with that in mind, then, how active do you want to be? Will it require you to get on the board to really see the sort of changes that you'd like to see at Tesla?
Actually not. In fact, it's funny you ran that quote, because I think, we did that Twitter Spaces where Elon and I actually had a sort of, I guess, digital face-to-face conversation. And I thought that was incredibly cool of him to just, address me directly and my concerns. And I think he listens to people. Hopefully, the people he understands really want to see him succeed, like me. And, I think he's made adjustments. I think Tesla's made some of the adjustments that I want. I'm not unhappy. I was really unhappy in December. I'm not as unhappy because I've seen some of the actions being taken by the company and by Elon to try to deal with this, but I still think there's more to do. But I think as time goes on, this will work itself out, whether I'm on the board or not, to be honest.
And I mean, it is going to be important, the sort of direction that we see, given some of these very ambitious production targets that Elon has for Tesla. How important is it going to be? Obviously, we've had a lot of missed production deadlines with things like the Cybertruck and other things. How important is it going to be credibility-wise for investors to really see these deadlines come through?
Yeah, and that's why I say this is probably the most critical year for Tesla since like the 2018, 2019 period when they were ramping Model 3 production. And it was like, if we don't get this going, we're BK, and now that's obviously not in the cards because Tesla's in such a good financial position. But this is a transition year of growth into the truck business, into the Megapacks business, and as well scaling Model Y production and Cybertruck production. So, I don't think it could be a more challenging year for the team at Tesla. But if they get to the other end of this year and achieve the business plan, boy, this is a huge year for Tesla, and investors have a unique opportunity. Even though the stock's rallying today, we value the stock over $200 a share. I think earnings estimates are now too low for Tesla. Everybody's downgraded their estimates. Expectations are very low for Tesla. And, it's rare that we've seen that. So I think for investors who can deal with the volatility of Tesla and Elon, this is a great opportunity.
And of course, a lot of that assuming that Elon, sticks to his word, doesn't sell any more shares of Tesla, because you're obviously still concerns about some of this Twitter debt coming due. But then in the call, we also saw that CFO Zachary Kirkhorn talking about the company attacking every other area of cost and unwinding cost increases created for these multiple years of COVID-related instability. Where then do you think, or would you like to see Tesla perhaps get more lean so that it can invest more in some of the growth that's needed to meet these production targets?
Well, Tesla's pretty lean, it's not a bloated company in any way. I think it's really more about, their costs for transportation, their costs for inputs like aluminum or lithium and such. So we're seeing all those costs go down, and they do have contracts that are longer term. So how that all works itself out, we'll have to see. But they're relentless cost cutters during the ramp. And we saw this in 2019, under Jerome Guillion, where as they ramp, they find efficiencies in their production lines that, bring down costs. And really, this is where we get to the opportunity of really making a really affordable Tesla one day, maybe like a $25,000 or $30,000 Tesla one day, is really about the scale. And when Elon thinks about scale, he thinks massively. And that's what I think a lot of people underestimate about him, is the massiveness of his vision. And so we expect, costs come down. They seem to want to hold prices where they are, and margins will come back from Q1, which obviously will be impacted.
Indeed, and keeping an eye on perhaps the Chinese competitor that he mentioned,
right?
Whoever that may be, who might take the throne, if not a legacy US
Well, it's
maker.
BYD.
Thank you so much.
Yeah. Sorry.
BYD. No, you're fine. It's good. We'll be keeping an eye on then on BYD as well. Always good to have you. Ross Gerber there of Gerber Kawasaki.
Thank you.
All right. You're very welcome. All right. Coming up, calling all burrito rollers and guacamole makers. Chipotle is looking to add thousands of jobs ahead of its busy season. We wrap up the show with a trip down Chipotle Lane next. Chipotle announced it's looking to hire 15,000 new workers for its busy season as the restaurant chain continues to expand across the US and Canada. Dr. Palmer is here with the details. Obviously, they're hiring. Meanwhile, it's interesting. You're seeing a lot of tech still going through their layoffs and firings here.
That's right. Good morning, Rochelle. Chipotle investing heavily in labor this morning, out with that announcement of hiring 15,000 workers ahead of its busy season, or what it calls its burrito season, from the months of March to May. Now, it's important to confirm here that those new hires will be kept on beyond just the busy season. They're calling this what it calls a hiring campaign called Pull Back the Foil. It features employees who have rose in the ranks from crew members to managers. Now, in 2022, 90% of crew members, or rather managerial roles, were internal promotion. This comes as Chipotle has aggressive growth plans. It plans to open 7,000 locations in North America. In 2023 alone, it plans to open 255 to 285 new restaurants.
And Brooke, this comes as voters in California are set to decide on a new law that could come with some changes.
That's right. It's called the FAST Act. And as of Tuesday, the California State Secretary announced that it's going to be on the 2024 state election ballot, as it was supposed to go into effect on January 1st, but a petition gathered enough signatures for it to be put on pause, I guess you could say, and put on that ballot. Now, of course, this would form a 10-person committee that would ultimately be able to weigh in on minimum wage standards, health and safety protocols, time off policies, and more things that have to do with labor and wage for fast food workers. But some opposition here. Of course, CEOs not liking this, but unionization efforts and union groups certainly advocates for this, as they're always looking to improve labor and wage conditions here. But C-suite's talking against it. The latest announcement comes from McDonald's, who spoke out on the Fast Recovery Act, saying that, in part, an unelected council of political insiders, not local business owners, and their teams will make big decisions about crucial elements of running a business, fracturing the economy in the process. And this has been an ongoing concern. Last year, Chipotle CEO weighing in on this and the impact that it could have on a higher wage.
All right, Brooke De Palma, thank you so much. Well, all right. Well, before we go, we're going to do a final check on the markets to see how they're doing. The major indices still in mixed territory. We see the Dow there still in relatively flat but negative territory, pulled down by IBM. We see S&P there up just about 0.25%, and the Nasdaq there up about 0.2% as we head into the noon hour. Well, that's it for now. I'm Rochelle Akufo, but I will be back tomorrow at 11 Eastern. I'll see you then.